reduction in mineral production 10 years on from the Paris Agreement. And I'd like to welcome to the stage Gail Rouleau, a partner and MEA Energy Lead from Kearney. Thank you.
Thank you. Thank you very much. Please join me here. Thank you, and welcome to our panel that is focused on the carbon reduction in mineral production today. As you heard, I mean, we are 10 years from the Paris Agreement. Paris Agreement was a moment of realization that carbon is extremely meaningful and that we need to do something about it in all our industries. And it was a moment of realization, but also a moment of commitment from different players. Both public and in the private sector. And if we think of the mining industry is really in the spotlight today in the energy transition for two reasons. The first one is that a lot of the minerals are critical to enable this energy transition. We cannot electrify without having access to copper, lithium, etc. But at the same time, we are in an industry that is quite carbon intensive. So this is what we have to navigate. I'm extremely happy today to welcome in this panel a group of leaders that represent different perspectives in technology, in energy, and also in end-to-end view of the mining industry. So please welcome with me Christian Dai, Research Director, Environmental Technology at the Institute for Energy Technology. Thank you. Niklas Lukansky, Head of Mining at SLB. Thank you. Roland Chavas, Secretary General and co-founder of the International Lithium Association. Thank you. And Turki Al-Sheri, Regional Vice President for the GCC for ENGIE. Thank you. So, if we think of the past 10 years, we have achieved a lot in the decarbonization or the carbon containment of the mining industry. It has not been easy. It has meant a lot of investment, a lot of research and development in technology. A lot of trial and error, but the industry has definitely been intentional. Turkey, if we think of specifically the energy part, because energy is one of the big contributors to the carbon footprint of our mining industry, how would you describe the achievements that have been performed over the past 10 years in reducing the carbon footprint or containing the carbon footprint in the energy?
Thank you for the question. So I think since, for the past decades, even prior to the Paris Agreement, there's been a lot of initiatives and direction towards sustainability. But in the past decade specifically, I could say that I don't know personally of any country or multinational company that does not have a sustainability target. And we're seeing this moving from just simply measurements to actual action on the ground. Now, I know in the mining industry it's a little bit more complex because the lifespan of the mining industry can range sometimes to be very short, therefore making the economics quite complex. But nonetheless, if we look at the technologies and the development of technologies, I'd like to take one for example, is battery storage. Battery storage today is 50% less than it was 5 years ago. And the projections 5 years from now is 50% less. The lifespan of battery storage is 10 to 15 years. So you're no longer requiring the 20 plus year outlook to make the economics work. Now, in the mining industry, I think we should be looking at more than just simply installing renewables. We should be looking at really complete solutions that give long, durable, agile power that actually does commit to a significant portion of the carbon reduction. And this is really achieved, and you see it happening a lot in many other industries with respect to the commitment that developers provide. And that's where I think maybe is a link that's missing between the mining industry. I do see it happening more and more in the past years. However, it's not really as significant as you see in other sectors. And this is really the beauty of where, when you bring in energy developers, they're able not just to relieve your capital, but they're also able to guarantee that a certain availability, guarantee a certain performance. So you're reallocating that risk to a third party that helps you achieve your carbon commitments. And obviously this should take place not years later after the mining industry has been put in place, but really at the design stage. I think that this is something that should be looked at an early stage and should be integrated as part of the entire business plan.
Thank you, Turki. And I like the mention that you made on the end-to-end and the link between the different blocks of the value chain. If I think of lithium, Roland, I think it's one of the minerals where you have a strong connection with the end customer. So how does this impact the way you look at decarbonization and the way you've been going along that route?
Thank you, Gail, and it's a great pleasure to be here this morning. Hello, everyone. The lithium industry as a whole, because somewhere close to 85% of our material goes into rechargeable portable batteries, either for electric vehicles or for battery storage like solutions, we cannot get away from it. The lithium industry is quite small. That's the first thing to appreciate. It has maybe 9 or 10 key producers who generate about 90% of the lithium in the world. And that means that there's only 10 phone numbers that the sustainability manager at Mercedes or Ford needs to have in their little black book to phone up and give a hard time if they need to reduce the carbon footprint. So it's quite a short, transparent, small industry. Surprising for such a widely talked about lithium industry. The expectations of the OEMs filter very quickly all the way through the lithium industry. But it's not just the OEMs, because the OEMs, of course, are dealing with the end users, the public, you and I, all of us. And they are selling EVs directly to the consumers for many reasons. But among those is cleaner air, lower emissions generally, particularly greener transport. And you can't sell an electric vehicle on the benefits of reducing your personal carbon footprint if you have an enormous coal-fired smoky power station to provide electricity for the mine which generates the lithium in a very uneconomical, very carbon-intensive way. The mental loops you have to jump through to justify that just don't work. And so there is tremendous pressure from the consumer to the OEM, and then from the OEM directly to the mining companies in lithium, and to a certain extent in nickel and cobalt as well, and graphite, of course. So yes, the lithium industry is very, very aware of the carbon story, and it's a story that we go to great effort to address and deal with.
Thank you. So you mentioned this pressure from consumers and this connection in the value chain. When we were preparing this workshop, we were debating and discussing about what's happening in other industries, and recognizing that all of us have been navigating through mining, energy, and oil and gas. If we think of that, Nicolas, from Schlumberger, what are the cross-fertilization examples that you have seen between different industries that have benefited from mining, or what are the further cross-fertilization opportunities that you see to help mining contain its carbon content?
Thank you very much for the question. Obviously, as you mentioned, Schlumberger, or SLB as we're known today, has been in the business of exploration and production of oil and gas for the last century. So when we saw the need for especially critical minerals like lithium or other aqueous minerals, our first thought, can we bring a better exploration techniques and better production techniques that, first of all, can better define the resource and reserve, then extract that reserve more efficiently, and then process it in a way that you use less energy, less water, and less land. And that's exactly what we did with our demonstration unit in Nevada, where we're only using 7% of the land compared to evaporation ponds. We're using 95% less of water, and we're using only 5% of chemical reagents. We also focused very much in behind the meter energy savings, and this is what you talked about, NG. Mining is an extremely energy consuming industry. So by finding a way how to recirculate, how to use more efficient methods that we use in oil and gas for water generation, we managed to reduce our energy consumption by 3 times. And just to give you an idea, that each gigawatt of energy we don't produce from diesel generators, that's 6 million tons of CO2 a year. So by reducing it 3 times, this is a significant impact on decarbonization. But I think overall, my main message to the miners is, if we use the more efficient exploration and production techniques, we will define our reserve better, we will mine less, and we will produce more, which means that we will reduce energy efficiency of each ton of mineral that we produce.
Okay. No, that's clear and that's great, and thanks for providing these very tangible examples. If I turn to you, Christian, with your hat of research and foresight, how do you see the portfolio of technologies that are available today or that are emerging, and how much can we expect more from technology to help us go further in this carbon containment?
Yes, I think I will start with technology where we are generally on track. And here the keyword would be the electrification. So experience and research show that measures related to electrification of mobile equipment and transition of renewable power under the scope 2 and energy efficiency of through the digital optimization using, for instance, AI, are major technologies with demonstrated impact. And these solutions are particularly effective when you integrate them early in the design of the mining system and the mining value chain. When it comes to the area where the expectations are a little bit too high, I would say you have to dive into specific technologies. So for typically hydrogen in heavy mining equipment, I would say that full-scale carbon capture in mineral processing, and also radically new process technology. You can see that the technology maturity, infrastructure availability, and cost levels remain significant barriers today. And in these areas, you can see that there is an, let's say, misleading extrapolation from the status today into the full industrial level of the technology. As a general perspective, I would say that from the research, when it comes to decarbonization, it's not primarily a technology gap or missing technologies. It's more like the lack of the system integration. You have to take into account all the technologies. You have to start with the ore type. You have to look at the energy availability for the mine. And you also have to take into account the regional framework, the regional boundaries you have to operate under.
Okay. Very clear, very clear. And so definitely a lot of things have been achieved, and we still have a few opportunities in the pipeline, which is good news. But we also need to recognize that containing carbon in mining is difficult. A lot of the technologies that we've been or solutions that we've been discussing are still at a pilot level. Scalability is not always there, or are applicable because only in a certain type of mines, or if we have access to connections to the grid. So my next question for you as a group, as a panel is, where is it that we have experienced the most constraints, the most hurdles in this decarbonization route, and why? Is it on technology? Is it on capital? Is it on people? So what have been the main constraints that we have experienced? Roland?
Thank you, Ger. If you don't mind, I'd just like to take a step back before addressing the question specifically and acknowledge that, yes, mining is responsible for about 3% of global carbon emissions worldwide, according to the ICMM. But at the same time, mining, particularly for metals and for energy, but mining in particular, it allows the decarbonisation of many, many other industries. Having these, particularly some of the more what are currently called critical raw materials, they allow decarbonisation. We could decarbonise the lithium industry by simply stopping mining lithium, but then we wouldn't have lithium to go into the batteries to decarbonise many, many other industries. So I think, touching on a point that Robert Friedland made yesterday on the main stage, when he described that the entire amount of copper that humanity globally has dug out of the ground since the very first times when we sat around a fire in a cave thousands of years ago, that amount of copper needs to be dug again in the next 5 years if we are going to meet decarbonisation goals. That is the level of a critical raw material, in this case copper, that we need to meet the Paris Agreement goals. So we shouldn't be too hard on ourselves. We should recognise that increasing mining considerably is an investment in carbon which will, in the longer term, decarbonise. It's a tricky thing to keep side by side in one's head, particularly for people outside the mining industry. I try and explain it to my kids and they just don't get it. But we need to invest in carbon to save carbon in the long term. So,
Interesting point.
Thank you.
Maybe if I can add to this, I think, look, mining industry obviously has its challenges as any industry to decarbonize, but I do think that over the last decade, because there's a lot of pressure to ensure that the minerals and metals that we deliver to our customers have the lowest environmental footprint, that the issues of energy supply and the type of equipment you use, etc., have been all addressed. But there are some fundamental new technology available today that are, like, for example, in lithium is the direct lithium extraction. But there are other, let's say in the rock mining, can you use in situ mining or precision mining to reach the mineral in a more efficient way rather than creating a mega pit? Can you use a more efficient ways to dewater mines You know, today, for example, we completed 3 projects in Australia and Papua New Guinea where we used oil and gas directional drilling to create only 1 water well instead of 60 for the same pit, and then recycle that water through one central water facility. So you're now using a lot less energy, you're perforating less, so you're emitting less CO2 during the perforation process, but you also maximize the water reutilization within that same mine by purifying it and bringing it back. In situ mining, there's of course still a lot of environmental concerns how we bring it, but more and more technology does allow us to control the reagents that we inject and extract them without contamination. You know, and basically at the end of the day, that's what we use today in non-conventional oil and gas. So we're basically taking a non-conventional oil and gas technology and adapting it to in situ mining with a lot of chemistry in the middle that are very specific to the mining sector. So once again, you're solving decarbonization by combining the industry knowledge that comes from chemical industry, that comes from oil and gas industry, and then the third is from the IT industry. You know, we haven't talked, but one of the big drivers of the decarbonization is going to be machine learning, digitalization, automation, and artificial intelligence. And those things are coming to mining very, very fast.
Thank you.
Maybe a challenge specific to the energy industry, but I think what might turn up to be beneficial for the mining industry, and that's what you hear nowadays a lot is the intermittency of renewables, solar, wind, being only available during certain parts of the day or the evening, and as a result, it's causing some challenges with respect to the grids. But what I think we're missing out on is how are we compensating this intermittency today, or what are we seeing different utilities apply to do that? And what we're seeing is, as I mentioned earlier, battery storage. We're seeing advanced inverters to provide reactive power as opposed to relying on conventional machines. And through resolving this particular challenge, you're actually creating a far greater, more resilient system. And that resiliency comes from the diversity of technologies that you're putting into your power grid as opposed to what was used in the past through conventional machinery and turbines. How I think this relates to the mining industry is because I do know that some mines are not close to grids, they're off grid, but through this variety of technology, you're actually able to create a microgrid. And this is taking place today in several locations we see. I mean, if we're talking about Saudi Arabia in specific, if you look at the Red Sea, that's a microgrid. That's a fully isolated grid that has a variety of technologies to provide its power needs. And as a result of that option, it's actually quite a resilient system, which I think could also be applied towards the mining industry as well.
Thank you. Yes?
I would also like to point out some challenges. I would say that you see one of the challenges is that the fragmented approach in many cases. So many initiatives fail because they optimize on individual assets or single emission sources rather than considering the entire value chain from mine to finished product. And this can lead to suboptimal capital allocation and limited real emission reduction as you like to have it. Another thing I would like to point at is I would say energy realism in the project. You have to have access to stable, low carbon energy, and this point is very often underestimated in the mining projects. So in practice, projects are delayed or scaled down because the energy system does not develop in parallel with the mining project. So energy realism is extremely important to put into the project. It can also come into I would say the time dimension here. There is also a challenge when you see the technology maturity, how this corresponds to the decision point for the investment in the project. There's a time like here, so very often the technology is closed before, and then the capital is raised, and later on it shows that the technology is not mature enough for going into industrial scale. So I would like to emphasize these challenges here. They need to be addressed in the project development.
Okay, yeah. Thanks. This is very clear and makes a lot of sense, and it connects very well with the rest. I mean, let's recognize we have achieved a lot in an environment that is quite fluctuant, not always easy to navigate with different components, technology, capital, people, regulations. If we think of the next 3 to 5 years, what are the key decisions you think that the mining industry needs to take to make sure that we continue on this trajectory, or we even accelerate the trajectory of carbon containment? And Roland, I liked a lot what you mentioned when you were saying think end to end, and you were not thinking end to end only on the value chain, but you were also thinking end to end in time.
Yes.
I like this. Let's try to think really holistically, and what is it that we need to do different in the coming years to make sure that we continue to have this trajectory.
I think end-to-end solutions are absolutely essential. On a national level, we have the nationally determined contributions for each country in the Paris Agreement, but there's no point in one country completely decarbonising by exporting all of its heavy industry to its neighbour, whose carbon footprint then goes up proportionally. Similarly, in the mining industry, there's no point in taking, as you say, a single asset in isolation. You have to look at the complete value chain. And I guess in lithium, we're slightly lucky because of this quite transparent and relatively short value chain I mentioned at the start. Means that the OEMs, when they do the carbon footprint of the battery in their electric vehicle, they don't care if the mine is high carbon and the refinery is low carbon, because it's the combined total which goes into the battery. And therefore, that gives you the opportunity, as Nicholas was saying, to have low carbon here, low carbon here, low carbon here, all the way through, so that the net aggregate total carbon in the battery, that's what matters far more at a system basis than the fact that this mine here has decarbonised, but yet this refinery next door is coal-powered. There's a lovely example from Argentina, where a Chinese lithium company called Ganfeng Lithium it's miles from anywhere, up in the Andes, about 3,000 meters. There's very little of anything up there. Very little water, very little greenery, very little energy. And so to extract the lithium from this particular site, which I'm sorry to say, Nicholas, it's not DLE, it's the brine ponds, but nonetheless they use solar power plus overnight storage batteries. And the reduction in diesel generation has been enormous. I mean, that their carbon footprint just collapsed the moment that it was all in place and turned on. And so there are some really accessible wins which have a dramatic impact. And yes, with new technology, with new systems, thinking the complete value chain, it's very exciting.
It is.
It's very optimistic.
Maybe I know that a lot has been achieved since the Paris agreements, but I think there's a lot that still needs to be achieved, right? So if you look at the science-based targets, or SBTI, we're still way far behind schedule when it comes to achieving that well below 2 degree objective. But if we look at the mining industry, or something I could maybe assimilate that I've seen in other industries that I think could be adopted by the mining industry, is decarbonizing or creating a sustainability strategy at a group level. And when going out to identify solutions. It's really looked at a holistic view. And an example that I've seen specific to Airbus is they've recently tendered maybe 60 sites, all with clear decarbonization objectives, and worked with one or two major energy developers. The benefit behind that is the economies of scale, is the logistics, is the procurement. So this is maybe another way that I think the mining site can look at it, is really from not just focusing on one particular site or two, but really looking at the entire portfolio and trying to identify from a group level what decarbonization targets do I need to meet, what can be done, and really applying and executing that on a multi-site scale. Because again, that also will help, I think, significantly with respect to the economics.
Thank you.
I completely agree with the point about the holistic view when you are planning here. And talking now about in the next 3 to 5 years, I mean, but this is also valid for the future as such. I would say that the most critical decision to take is to integrate decarbonization into the mine process and planning already from the beginning. This is valid now, it will be valid the next 3 to 5 years and also within the next 10 years. You have to integrate it from the beginning, because a retrofit adaptation to decarbonization is costing much more and is much less effective than planning from the beginning. So that's my advice, and also connect with a holistic view here, the whole value chain from the beginning of the project.
I think what you're saying is correct, but it comes with the governance and it comes with the clear carbon management. So I think there is still a patchwork of policies in terms of how do we manage carbon from country to country, from industry to industry, even within the same country. So that's very important because that will drive. And then even within the industry, we look at carbon management very differently. There are certain, so the more intra and inter-industry conversation we have about how to manage carbon, I think the better outcomes will be, because that will drive the way we produce energy, that will drive the way we capture carbon, reutilize carbon, sequester carbon, and then avoid carbon, either through better mining methods, recycling, recirculation, etc. So I think it's that holistic, as you said, carbon management approach that will drive the decarbonization success over the longer period of time. And I think the next 5-10 years, with introduction of certain policies, usage of modern methods, whether it's AI driven or something else driven, will help with that.
And just pulling the string on this topic of policies, governance, and creating the ecosystem that will inside the ecosystem to go there. What could be levers there? So who should be acting? Is it governments? Is it companies? Is it society? I mean, where do we expect the influence to come from?
It's a philosophical question, but I think it's a combination thereof, and we already see. I think that's I think yes, there will be always a difference. There will never be a completely homogeneous policy, but nonetheless, if you see the societal acceptance that climate initiatives are required, and I think more and more we see them throughout the world, the interpretation of them might be different, but I think the directional policy chain is there. And I do believe that at the end of the day, we as consumers starting dictate more and more the way the supply chain works. And so the private sector is responding to that stimuli, let's call it, that we're sending to the industry.
Maybe just very quick on that particular topic. I think it's everyone. I think you can't do one without the other. You know, it can be policy, but companies not taking action, or companies, but policy not taking action. So I think each and every sector, whether it's public or private, really needs to act through either regulations, policies, grants or incentives, And in turn, the companies obviously need to also ensure that they apply these practices, find the most economic way of doing so, making it make sense. But I believe it can't be one or the other. It really needs to be all the sectors involved.
Definitely. Yes.
I mean, decarbonization should be easy to sell, working to improve and implement the decarbonization. And the social acceptance is an Achilles heel for all kind of mining projects. So maybe the working totally with a social acceptance from the beginning. And also when you start to plan the mining in a specific area, you have to involve the society in the plans and show the upsides of the activities, because it's not difficult to find, for the public, to find some negative to point at in the project. So I would say work totally with the social acceptance. We have seen this in several cases in the Norwegian country.
Okay.
A level playing field, as you say, everything measured the same way. What gets measured gets changed. And if we measure everything in the same way globally, for a lithium, or for cobalt, for nickel, graphite, anything, then we can all work together towards getting it better. The Lithium Association, just to mention, we have our own lithium footprint guidance, which has been adopted by, I think, 17 companies already, which is very good. They at least are doing it the same way, as opposed to making spurious claims about how they do it better. If I may, Gael, I'd just like to, as my personal final word, go back to a quote which the Vice Minister for Mining Affairs opened the conference with yesterday, which is, collaboration is vital for the scale of the challenge we face globally. Collaboration, it really is the most important thing, all facing the same challenge and working together.
Thank you. So, Turki, Roland, Niklas, Christian, thank you very much for sharing today your experience, your expertise, your vision, your aspiration. It was a very rich discussion, and I thank you very much for bringing all this to FMF 2026. Thank you very much.
Thank you.
Thank you.
Okay, so theoretically I go.
Actually, just come on up.
I get the best seat. How are you?
Good, nice to see you again.
Fantastic.
Hello, everybody. Thank you so much for joining us. We're here to discuss the commodity outlook, and what a lot of people often just take for granted is how essential commodity prices are to the mining industry generally. The reality is mining companies are ultimately price takers, and they live and die by the commodity price. Yet, commodity prices are something that has absolutely confounded forecasters for years. I mean, even Goldman Sachs regularly, like very regularly, gets it wrong. So we've assembled an incredible panel today of people from different parts of the industry who have a much better track record at getting it right, to be perfectly honest. They're all going to discuss their sort of long, medium, and short-term outlooks for the commodity sector. I'm going to ask each of them to introduce themselves and what their companies do. But we're going to start with Matt Fayfield, who's the managing partner of Pacific Road Capital, a very long and renowned investor in the mining industry. Matt?
Thanks so much. Just checking, can you hear me okay in the back? Yeah, okay, great. So tell me what would you like to hear?
So introduce yourself and sort of what you do and what Pacific Road does.
Yeah, fantastic. So we're a mining investor. In general, we focus on turnaround and underperforming assets in special situations. So I have a different, I probably have a little bit of a different perspective from some of the other guys on the panel, because usually we're looking at things where something is going wrong. And sometimes that's price driven, sometimes it's management driven, sometimes it's asset driven. But we start with the prospect of looking at things that are going wrong and to figure out how do they go right. So when we're looking at things like commodity price cycles, we're generally focused in the short to medium term rather than on the long term. But anyways, thanks for having me on the panel today.
Great. Next, Michael Crandall, the managing partner of the Primary Commodity Fund.
Yes, so our strategy is we invest across 65 metals. We're physical metal traders, so unlike many investors in the commodity space who focus on the futures markets of the big listed metals, we focus more on the niche smaller metals, so think rare earths, critical metals, the super alloys, and really focus on our unique advantage of understanding what's happening in the physical world, right? So we have visibility into about 1,900 suppliers, and about 2,000 industrial customers. So it's a little bit of a throwback to the way the commodities investment was done. Many years ago, our markets are almost purely driven by physical attributes and supply-demand dynamics as opposed to financial speculation. And the other thing that we're working aggressively on is implementing agentic AI models. So models that are autonomous, independent, and proactive, to provide unique perspectives and to perceive what was previously imperceptible, specifically as it relates to demand trends. The industry's done a pretty good job historically of understanding supply. We think that AI has tremendous potential to provide unique insights on the demand side.
Excellent. Martin Valdez, the partner and head of private equity at Resource Capital Funds.
So I run the private equity strategy of Resource Capital Fund. We are a mining private equity firm. We have been around for 28 years. We pioneered the concept of raising capital to specifically be deployed in the mining industry. We have done over 240 transactions through the life of the funds, 30 plus different commodities, so we're agnostic in terms of commodities. We obviously follow the trends, and today is all about critical minerals. 50 plus jurisdictions, so we're absolutely global. I would say we're a very technically driven firm. We're very hands-on investors, so we tend to do few deals per fund and be an active investor and help companies. I would say our sweet spot is helping companies building projects or optimizing them.
Great. Thank you. And last but absolutely not least, Ken Hoffman, the founder and CEO of Trub & Buck.
My name is Ken Hoffman. I spent 35 years in the mining industry as a portfolio manager, director of research. I recently, after a decade, left McKinsey & Company, where I ran their global battery raw materials and value chain work. Since leaving McKinsey, I've joined or am part of six boards on companies sort of in cutting edge, all the way from AI in the mining industry to DLE technology, to companies who are going to make the next generation batteries. I also am head of commodity strategy for a Canadian brokerage, Red Cloud.
Amazing. All right, so what you're all here for, because you all want tips, right, is what is our short, medium, and long-term commodity outlook? And maybe, what do you think is going to do well, if you can give them a couple of tips in terms of commodities. Let's start with you, Matt.
Fantastic. Look, so my perspective I just want to take the long term off the table, which is to say that over the very long term, I'm very pro-humanity. And what I've seen is human ingenuity manages to find supply-demand curves that work, and we actually manage to bring supply online. So if you're in a period of tightness, what ends up happening is customers thrift and shift, and they change their consumption patterns. And sometimes when you're just creating linear projections of demand, you forget that, and actually that the market is dynamic. So over the long term, I'm not an alarmist. I don't think we're running out of commodities. I do think that in the short term, though, it's very interesting. And so what we have in the short term is we've got a market that's driven potentially by scarcity. And if you want to look at models of scarcity pricing, you look at underinvested sectors. And so I would point, for example, to the met coal sector. What happened is met coal is fundamental to make iron, and when it ran out, all of a sudden prices went to levels that people never really believed, $300 a ton. But once the psychological barrier of, okay, if I really need it, I'll pay $300 a ton, then the next time the world ran out of met coal on a prompt basis, it was a $500 price barrier, $600 price barrier. And so I think in this time frame right now, because I don't really see people building supply en masse yet, that we're likely to encounter these small pockets of scarcity. And what that actually means is look for those pinch points. Copper's an interesting one right now, where people will psychologically run out of copper or hoard copper so that somebody else runs out. And you may get these snap price surges that last for a moment, but for the operators or investors in the space, they'll make 7 years of profit in one, because it just, costs don't catch up. In the medium term, what I think about, and obviously these guys are much brighter than me, but I think about what's changing productivity and what kind of mines can absorb new technology in hydromet, new technology in autonomy, and marginal improvements around AI. And it makes me quite optimistic that in the medium term, you'll see invisible supply growth as opposed to step change new mine supply growth from the impact of technology and demand. So maybe that's not the precise answer you're looking for, but when I frame it, in the short term, we're looking at where are you going to see scarcity pricing, and it's great to own an asset when a commodity price, goes asymmetric on that. And then in the medium term, we're looking for assets that could take benefit from some of those big drivers.
Great. Michael, you're especially into the critical minerals space, which is a little bit more niche than the rest of us. What is your sort of critical minerals short, medium, and long-term outlook?
So maybe it makes sense to go back a little bit of what's happened this year to give you some perspective. So in the critical metal space, in the rare earths, materials had flowed pretty much unabated up until the last 2 years. And what we're seeing now is the weaponization of these materials, which has thrown global supply chains into a tizzy. And I think the first phase of this was if you look back to April of this year, when you saw export restrictions, you saw very quick price moves. It's very important to note that the restriction of exportation of certain materials didn't happen across the whole spectrum of metals all at once. It's more of a systematic approach, starting with the metals where certain entities such as China control the largest percentage. I think as you look out over the next 6 to 12 months, you'll see further examples of export limitation. You can see that when the Japanese government made some comments about Taiwan, the rare earth weapon was used again. That was the driver of what happened this year. I think what you're starting to see now in the real physical world is corporations and governments start to respond to those dynamics. And so when we look across the host of metals we're trading, we're starting to see corporations that would normally carry, let's say, 3 months of inventory, 6 months of inventory, start to change those strategies. So we're going from a period of just-in-time to the accumulation of materials, excess materials, which pulls forward demand in order to be more resilient. I think that will be a big driver over the next year or so. And then obviously the other big driver is, for the first time since the end of the Cold War, we're starting to see governments actively build stockpiles. So we're still in the early phases of that. One from from an execution strategy, as well as from a full understanding of what materials are going to have the highest probability of becoming tight. The last thing I would just say about our metals that's different than many other metals is the price elasticity function of our metals are completely different in terms of, in many of the cases, the metals we trade are a very, very small percentage of the bill of materials of the end products. So, if you look at a $35 million jet engine at current prices, there might be $10,000 of tungsten. So I think, unlike a lot of the big metals, which have pretty quick responses from a demand destruction or a substitution perspective, our materials have a completely different price elasticity function and are much harder to substitute out of the end products they go into. So I think that's going to be a key driver over the intermediate and longer term for our space.
Excellent. Martin.
Look, same as Matt, my investment horizon is more 3 to 7 years, so I'm looking more onto the short to medium term. I mean, incredibly, but in mining, 7 years is just medium term. So long term is more for the next fund. And we spend, and obviously to invest in mining, you need to have a macro view. So we spend a lot of time trying to understand supply and demand dynamics of each of the commodities. We even have an internal team that is a commodity strategy group that at the end they try to go as granular to try to get supply and demand for each of them so we can come out with our short, medium views around pricing and put investment thesis around the different commodities. I would say the demand in the mining space has never been an issue. I mean, at the end, demand comes from the systematic growth comes from population growth and urbanization. But definitely you have certain catalysts at different periods of time. I think last one was the China boom in the 2012 that created the super cycle. And today it's all about critical minerals. And we're true believers about what we're starting to call, and again, I think the other panelists have mentioned, is technological advancement. So all about energy transition, electrification, decarbonization, penetration of EVs, and also now technological advancement. So everything around AI will require supercomputers, and that requires critical minerals. So we feel very strong about the demand side. And as Matt was saying, the supply is the trick. And this is an industry that has been severely underinvested. And I would say we are very keen from a fundamental standpoint, in 3 commodities. One is copper. We believe that obviously the demand side will continue growing for what I just said, but the supply side has been underinvested. Chile is going through their internal problems, so definitely there is disruption on the supply side that we believe that in the next 3 to 5 years actually will be a very interesting market for copper, and we're making big bets in copper right now from our side. The other one is lithium. I think penetration of EVs, battery storage will drive lithium demand. Supply is a little easier on the lithium side, but probably will take some time again to catch up with the demand. That will create opportunities. The other one that we really like is PGMs. Demand comes again from hybrid vehicles. I mean, every catalytic converter needs PGMs, and especially in places like Australia or US, it's a good replacement for EVs because it's more long-haul type of rides, and it also has a storage of wealth. I mean, we believe that gold is very frothy right now, so probably a lot of that will go into the PGMs that happened in the 80s, in the 90s, in different places. And the supply side is challenging. I mean, coming out of the majority of that coming out of Russia and South Africa, I think it's important. We did an investment actually in Brazil, so we're looking for PGMs all over. Gold, we like it. We made a big call in our previous fund in gold, and we got it right. We never thought that it was going to be at this level, so but definitely we were quite keen, and we always like gold as a hedge. Thing is, from a long-term outlook, we don't believe, or who knows. I mean, I don't think we'll remain at these levels. But even if you talk at 3,000 or 3,500, it's still a great market. So those are, I would say, the commodities that we really like.
All right, Ken, you have to follow that up.
I put commodity metals in sort of 3 buckets. I have the precious metals, the industrial metals, and battery metals. And the precious metal front, gold is the leader of the band. I actually have good news for you. I think gold, if it's not $10,000 to $20,000 in the next 5 years, I will be shocked. The United States is doing everything in their power to devalue the dollar in order to pay off its massive debt. They're doing everything to not trade internationally, and there's these trillions of dollars just floating around. Central banks understand this, and the one currency that Donald Trump cannot go after and attack is gold. And so you're seeing central banks line up a lot of gold. If we look historically, gold has had 2 prior bull markets from 72 to 79 and 2000 to 2007. They've gone up anywhere. I don't care about the price of gold, I care about the percentage. In the first bull market, gold went up 1,800%. In the second bull market, it went up around 900%. So we're up about 150% from the bottoms here. So percentage-wise, can you do $10,000, $15,000, $20,000 gold? I definitely think so, and I think the rest of that complex sort of moves along with it. In industrial metals, short term, I'm very wary of copper. I think if you strip down copper to real demand last year, it was 0. About 1 million tons of copper was put into inventory, be it inventory at the COMEX or other exchanges or governments buying them. That's not demand. That's just taking something and putting it in the storeroom. And I think with China, the economy is relatively weak. The US, I think, falls into recession this year by the end of the year. And I have industrial demand being a problem. Now, medium term, I think metals are the future. They will replace oil. And I think that's why Saudi is so interested in the industrial metal base, is they see this transition. It continues and it will continue. And so I would be very, very bullish mid to long term on the industrial metals because we will need those. But short term, I would be cautious. And as they always say, the cure for high prices is high prices in industrial metals, and $13,000 copper is going to cure a lot of things. Battery metals and batteries continue. The growth of battery materials last year was spectacular. You would think from a lot of the press that batteries had a poor year last year. Battery demand last year was up almost 50%. It's the reason why lithium, I was very bullish on lithium early last year, and you could see it in stationary storage. To understand the battery market, just look at Chinese battery production. If you looked at the high nickel battery production last year, it wasn't very good. It was only up around 13-14%. That's EVs. But if you look at LFP, which mainly goes into stationary storage, it almost doubled. So much so, the largest lithium company in the world, SQM, just batteries for stationary storage meant you needed to add 2.5 SQMs to the world demand. So while a lot of, even my old firm McKinsey was talking about long-term oversupply of lithium, 2.5 of the largest suppliers being needed in 1 year told me lithium's going to recover a lot quicker. Now, I never saw $24,000, $25,000 lithium so soon, and it sort of concerns me that lithium is moving way too fast and can sort of kill itself. Again, the cure for high prices is high prices, but that's going to be something. I think lithium is going to become the metal. I don't see sodium-ion batteries replacing lithium anytime soon. They have a lot of their own deficiencies. However, the one battery metal I don't hear much about that I think is going to have a huge impact is manganese. Manganese is used, and you'll hear batteries called high manganese LMFP or LMR. That is going to be the next chemistry. It has the same cost structure of LFP, but 50% more density. You can take out all the cobalt and most of the nickel in these batteries as well. It's called LMR. And manganese is going to be sort of the next big metal because it is such a big market. It's not cobalt with a couple 100,000 tons of global production. It's not nickel with 4 or 5 million tons of production. Manganese production is the same as copper in the low to mid 20 million ton market. So even if you use a huge amount of manganese in the battery industry, that's not really going to move the needle the way it did for cobalt and nickel in the past. So that's the way I would put sort of the 3 different buckets.
Great. So we have a bit more time, so I'm going to ad lib and put you guys on the spot a little based on your previous answers. Matt, we'll start with you. What you said, which was very correct and interesting, is that scarcity is what causes the real huge demand jumps. In lithium or copper, it's that short-term deficit that causes the incredible price spike that ultimately means a mining company can make 7 years profit, as you said, in 1 year, which is amazing. But what happens in a nickel situation or a previous lithium situation where that scarcity causes a slight overproduction, which always happens, and the price crashes way below where it needs to go? How do the companies survive in that situation? Because commodities scarcity can cause incredible price spikes, but then the tiniest oversupply can also cause incredible price crashes. How does the mining industry deal with that?
Well, first, I'd just like to remark that that's what makes it all so much fun, right? Is that it's very, it's very boom bust, it's very cyclical, and I can't wait to hear what you're going to say about like gallium and germanium and the impact. We're setting up with a multipolar world for a lot of friction, and that friction is going to be incredibly interesting and volatile and difficult to navigate through for the world at large, as well as people that are looking to invest in their portfolios. But I mean, that's the classic. If you look at lithium in 2017, resurgent, here it comes, this is the future. It wasn't wrong, it was just early, right? It was just early. And then it went through a valley of death where you could buy all the assets for free, right? And people are throwing things away, and it was just a terrible time in the lithium industry. And then we had a run that was amazing. And then we went right back to the crash. So, but I think that that's probably more because lithium specifically is an industry that was kind of being created, the demand somewhat from scratch. And the scale of the market that's being built is so big. So that shuttering stop-start is the mismatch between the markets and supply growth. And ultimately that figures itself out and it stabilizes. And that seems to make sense. I guess one of the things that is interesting is when those markets don't shutter and crash, right? So the antithesis of what you're talking about. So for example, I don't know if anybody else has noticed, but like iron ore is an incredible out-earner, right? That is one commodity that has not really come back anywhere close to its marginal cost. So it's an incredibly profitable industry. And what that means is that on one level, it's really hard to bring on mines at scale. And on the other level, demand keeps running away from supply, right? And the other area, and by the way, I love that we disagree on copper, and it's like so much fun to be on a panel with you. But another area where you don't see a retreat back to those classic 2/3 of the cost curve type of thing has been copper. And over the last 10 or 15 years, what you've seen is that every now and then it'll touch the 90th percent of the cost curve, but it doesn't really retreat beyond that. And it's been a big, long, profitable industry. And again, that's just for me a signal that supply is running away, or demand is running away from supply, because marginal costs don't matter, right? So all of and those are big markets with big scale. And I think eventually you'll get into that space with some of these other metals. The smaller the size of the market, the more niche the product, the more abrupt those changes can be and catastrophic for individual companies. So, handball, yeah.
Well, quick question for you though. I mean, if you whenever you see prices like lithium go to 80,000, or you see, prices go to levels that people sort of know are excessive.
I'm just very happy to be alive in those moments.
But if you go to a public company and you say, why don't you just hedge? They always say, no, we want our investors to get the full way through. But you guys are private companies. Do private companies hedge if they see it? Because I can always call up Goldman Sachs and say, hedge me out, and they'll give me a price. I may not like it, but do you ever see private companies, do you ever consider, when you know it's a bit of a bubble, to go out there and hedge it for 2-3 years?
Well, it's such a great question, but the way that I would answer it, because I won't answer your question. I'll answer a slightly different one, which is that the market structure is really important when you're thinking about where you're investing and what's the role of your customer. So if you take something like copper or iron ore, it's homogeneous, and therefore, or it's relatively homogeneous, and therefore can be hedged once it's in a semi-finished or intermediate product. But on the way in, the role of traders and customers are to balance the imperfections in the mix to make what they need from a quality standpoint. And I think the more technology specific the metals get, the more stress there is on that system. So it's about your customer relationship, and ultimately, if your company has a good portfolio of customers or somebody that cares, expand the realm of who cares, then you live through those price spikes. You don't get all of it, but you don't get, it's a symbiotic relationship because what you do matters for your customers. And so I would say in metals where you matter to your customer and, because of your specification or whatever, you may not be able to hedge, but your ultimate hedge is that your customer needs you to be alive for their business to thrive. And, a little different.
If I may add, we do hedge sometimes. I mean, we're a financial player, so essentially sometimes when we see an opportunity or an interesting market, we do tend to hedge. Probably not 100%, obviously, but significant amount. And the benefits of that is definitely changes your mind plan as well, because again, you can project a little bit the medium outlook. The only caveat I would say, as you said, Ken, before, is we need to exit at a certain point. And in general, mining investors, they like that commodity sort of risk. So therefore, we need to be very conscious that at the end, if we're hedging, we're not hedging a lot. So at the end, whoever can buy us can enjoy that commodity.
Great. So everyone in various different capacities here has mentioned AI, and AI is obviously one of the drivers of copper that everyone's talking about. But I'd actually like to talk a little bit about AI's ability to help with, frankly, what is a forecasting issue. This is about what do we think of short, medium, and long-term prospects for commodities, and the fact that commodities and commodity prices make or break any mining company in the long run. And forecasters have so often been wrong. It's such a hard, commodity forecasting is, I think, arguably one of the hardest roles in the financial forecasting industry. And I know that Michael works a great deal with AI because he works in even smaller markets that are more volatile and more difficult. How do you see AI helping commodity forecasting, both in the larger scale and the smaller scale?
So I would say, based on our experience, like I said initially, I think it provides a greater perspective on what's happening on the demand side of the equation. So for example, we have agentic models that will break down a metal. Pick a model like rhodium, right? We talked about platinum group metals. And we'll monitor every element of the rhodium market, from the analysis of every auto sale in the world by drivetrain. So is it ICE? Is it pure EV? Is it hybrid EV? We have agents that read all the specs on all the vehicles to determine what exactly the catalytic content material is. You alluded to it earlier. There's actually more catalytic material inside of a hybrid EV than even an internal combustion engine in many cases because of lower temperature. So you need more catalytic material in order to start the catalytic process. But we'll also look at things like what's happening with electricity availability at Eskom in South Africa, which provides a large amount. So I think what I would say is there were many elements of analysis in the industry where you were unable to actually get real-time data or somewhat real-time data about what was occurring inside of those markets, so you were flying blind. So what I like to say is what was previously imperceptible and, more importantly, quantifiable and easy to organize is a big area of improvement for AI. The other thing I would say is that when it comes to pricing, you can run more price summaries and analyses. So in my world, many of my products go into different end markets. And what you find, because they're not as transparent and as efficient as the big markets like copper is, I have to understand the different price breakpoints by application, right? It's not a big homogeneous, what's the price of copper on the LME? So for example, we build our own pricing models for, let's say, these smaller markets like samarium. Samarium goes into a lot of applications, predominantly in the aerospace market, for like actuators and F-35 fighter jets. So an F-35 fighter jet costs $120 to $140 million to make, based on various specs. At current prices, at current volumes, there's about 50 pounds of samarium, and at current prices, about $1,000 of samarium. So what we have to actually do in our world is create complex pricing models that say, what is the point of demand destruction? And why our metals are so interesting is you can obviously see that the opportunity cost of selling a product for $120, $140 million and slap a decent margin on it for Lockheed Martin, the price elasticity function is in the hundreds of times greater than the current price. So I think it's a analysis tool from a fundamental supply-demand dynamic, but especially in our space where pricing is more opaque and there's actually so many different applications, you have to understand not just what overall supply and demand is, but where each incremental buyer is coming from and what price they'd be willing to pay in order to ensure that they can make their product. And the last thing I would just say is, in our space, you mentioned gold. I mean, clearly, if you look what happened since the invasion of Russia and Ukraine, one of the big drivers of gold is the fact that you had a price-insensitive buyers in the form of central banks come into the market. And that was obviously to hedge treasury risk and other forms of currency debasement. In our space, without our materials that we trade, modern society can't exist. Military defense can't occur, missile defense systems, radar systems, AI can't exist. So we find that we have to do a more detailed analysis of price as you have the introduction of price-insensitive buyers into our markets that have more strategic objectives of why they're buying these materials.
Very interesting. So you discussed, I'm taking this slightly from another panel, sorry, Martin, but the time, and you mentioned, you care about a 5 to 7 year horizon, a medium-term horizon. How much is time and that medium-term horizon affecting your decision-making in terms of which commodities to get into?
So at the end, and look, I mean, it's all about supply and demand, and sort of piggybacking on what Michael was saying around AI. Where we put a lot of time when we build our own, again, models is what is the timing of a lot of these mines, especially in the big commodities. What is the timing for these mines to come into play? And that's where we make technical bets in the sense of, is this mine actually going to get a permit? Is this guy a good operator? And essentially the thing that AI cannot help you is in that technical aspect. I mean, when an operator will run into problems and at the end a big mine will come out of the market, that essentially will impact the market. So from our side, sometimes we like commodities, I mean, rare earth, for instance, right now. There's a lot of discussions about rare earth. Definitely rare earth is absolutely needed. But there are a lot of mines trying to come into production, and it's a very niche market. So what is going to happen 2-3 years down the road when a lot of these mines actually, they come into the market, and maybe they're going to flood the market. So those are things that we keep a very close eye, but we can play the rare earth market probably in a 1-2 year time horizon. So we put different investment theses around the different commodities, again, understanding again more our short, medium price outlook. So we played again we play the time factor in different ways.
Excellent. Last but not least, you mentioned something earlier about the fact that you think there's a tiny oversupply right now, despite the overwhelming global consensus that there's probably both a medium and long-term structural imbalance in the copper market. But this year, despite copper prices, you think there might be a tiny oversupply, or at least that the market's in balance. And as we know, that massively affects copper prices. Generally, it's demand and supply and those tiny imbalances that make or break the price of a commodity. How much is speculation and perception now playing a role for things like both rare earths and copper? How much is that affecting pricing, do you think?
I think it's everything. I mean, and look, I'll give you a couple things. One, if you thought research was bad before, it's only going to get worse. Because what is research? And we're talking about the difference. If I'm a trader of the metals and I'm in the flow and I know the cost, their numbers are 1 billion times better than what you're hearing an analyst on TV who's 28 years old, who's never seen a cycle, who meets a bunch of his friends, and they're all group speaking the same thing. The traders at Goldman and Trafi and all they know the markets, and they are making really good informed bets onto where things are going. So What worries me is every analyst now is going to go into their little chat bot and sort of ask it what's going on, and that chat bot is going to give everyone the same answer, and everyone's going to happen. And then what happens is all of a sudden something that the chat bot didn't realize is going to hit the market, and everyone's going to have to run out of that, and they're all going to be wrong. So I think volatility is going to increase with AI and sort of the way it's being used in research. I'm worried about that.
All right, so go for it.
Sorry, just in terms of balance, right? So the markets can be balanced in terms of supply and demand, but what we're not talking about is we're not talking about inventory. And in a world that is has a security trade on, I can't remember, Ken, if it was you or Michael, I was talking about like growth in inventory. It's a massive effect. That silent inventory, if I'm not sure I'm going to get my samarium, you know I'm going to hoard it, right? Yep. Like so that's going to cause a whole nother level, and that's something that's out of a visible demand.
Oh, it's exactly what's going on in the copper market. I mean, Trump's going to ban it and put 50% tariffs, so everyone's seeing the ARB and they're all bringing it in. But to me, that's not real demand. When I had sitting in a COMEX warehouse, it's not to me demand, and that's what worries me. How much? First of all, that demand, does it continue again this year? You get another 1 million tons, or so at best, it's sort of, you won't see that demand replicated. At worst, sometimes that inventory is going to come back into the market, which is then all of a sudden going to have a problem. And so I think the machinations, I mean, what the US government is doing in the world of commodities, it's creating this ball because we're all thinking about rare earths and all these other different metals as the world sort of breaks apart. So I think it's going to be really challenging.
So I'll just add one thing from a physical side that I think helps put this in perspective. If you look at the end of the Cold War in 1989, the United States government had about $40 billion in today's dollars of stockpiles of material. At the end of 2024, that number was less than $1 billion. And so I think it's just important to understand what it was in a different regime, like a Cold War, global conflict regime. We lived through a 30-year period of relative globalization, stability, and so forth. But I think this is more of at least from my perspective, it's a bit more of a secular phase of accumulation. 100% right that it'll happen in different phases and different metals, but we're only in the first inning of replenishing the stockpiles of the magnitude they existed historically.
Totally. What's the demand for an F-35 fighter? I think it's going up, right? Unfortunately for our world, I think it's going up, but also what you're saying. So one of the things that Martin and I would see in terms of making investment decisions is somebody will come to us and they'll say, hey, I've got this mine, it looks really good. We're going to make I'll pick on scandium, we're going to make some scandium, but our mine's going to make 20% of the world's scandium, right? And they're like, can you help us? And that's actually a really interesting question because for the last 15 years, it's like, no, I can't help you because you will single-handedly overwhelm the world's scandium supply. And so I'm curious, I don't know that the answer is different, but I suspect it could be, and I'm really interested in your perspective on that because you're down in the weeds in those markets and seeing how that works. And it's true that the binary metals that you just can't do without, suddenly there's a long-term effect of you've swamped the market demand, but there's a short-term availability crisis that is playing out right now. And so I'm really interested to see what you...
So it's a great question, and there's two elements to it. The first is, what's your starting point? So many of the metals that I trade have been trading at or close to marginal cost of production because of China's strategy to dominate the market. And that's been that way for 30 years.
Yeah.
And so I think the first element is that is the low-cost marginal product. But if you want to break dominance, you have to build your own capacity. So the first thing you have to ask is not just where is the supply coming from, but where on the price curve is it coming from? So the Western world price curve for these materials is completely different than what the cost of production is in China. That's why you saw a change in US industrial strategy. And probably the most interesting thing from my perspective of the MP material deal with the Department of Defense was for the first time the US government put a price floor on the price of neodymium, right? Because they know that if a Western provider wants to build a neodymium rare earth facility, they can't make money at $50 a kilo, or $60 a kilo, which it was. It needs at least 110. Based on the numbers we look at, I think the number's higher than that, to make a real economic rate of return. So the first thing I think you're going to see is you're going to see supply come on, but you have to understand that there's a structural shift in the price curve. It's I think maybe a good way to think about it is very similar to what happened to the oil market in the 1970s with the advent of OPEC. So the first thing that is going to happen is we're going to see a completely different structure of price curves. And then you'll have to determine, and in many cases, this could be 100, 200% increase from the prices that you see today. That'll be the first phase. And then I think the other thing you have to think about is once you have that material, it will increase supply, but is there latent demand that nobody can see right now? Meaning, because it's a tight market, the end consumers can't get the material, and so you'd think normally, and this is true, and there could be dislocations, you get a 20% increase, prices must crash. Not necessarily true. You could, if you've ever studied like Jay Vaughan's paradox, which is as a technology becomes more available, as it declines in price, its application goes up. So I think the other thing, last thing I would just say on my metals is, unlike copper, which in a good year grows 2% and a bad year grows 0, or let's say 1%, many of the applications of the metals that I trade, they're growing high single digits, low double digits per year. So that completely changes the dynamic in the cycle. So you can get a little oversupplied, but it's not, let's say, like the copper market, like if you go back and look at what happened, copper cycles 7, 8, 9, 10 years, right, because of how long it takes to bring on a mine. If you oversupply one of those markets at 1 to 2% volumetric growth, it can take you 5, 6, 7, 8 years, 10 years to close the gap. In our space, if you're growing 10% a year volumetrically, a 20% oversupply can be absorbed in a year and a half, 2 years.
Yeah, but that's trading something. But I mean, we saw when China cut off the world in rare earth metals and they went up 3,000%, and the U.S. Department of Defense says, build all these mines, guys, go out, build it. And then all of a sudden China said, we're going to supply the market. And all of a sudden the Department of Defense went back to Mountain Pass, who went bankrupt, and said, who are you guys again? I mean, it's hard to make a 7-year investment where we don't know if the next administration comes in and says, it's really hard.
I feel bad for you guys. I can change my mind every day. You make a decision, you have to live with it for 7 years.
And that's
So, sorry guys, I hate to interrupt, but we are running out of time. Can I ask you to leave a quick takeaway with the audience, because commodity markets are so important? What would you like the audience to remember about commodity markets going forward? Start with you.
I'll pass. I've talked a lot.
I would just say, be prepared for the traditional way you analyzed commodity markets was based on simple supply and demand. I think the biggest incremental driver is the advent of price-insensitive buyers in these markets, as well as understanding what the inventory accumulation process looks like over the next 5 to 10 years.
Excellent. Martin?
We have all actually spoken about history. So I think track record, going back again to what has happened in the past, boom and bust, what were the reasons? So not really drinking the Kool-Aid and really being very careful and go as granular as you can in try to guess the supply and demand.
Excellent. Last but not least, Ken.
I think long term we are in a completely new world order. I think we all agree upon that. And I think the next wave right now is you will see the biggest wave of M&A activity in the mining space the world has ever seen.
Very interesting. All right, thank you so much for your time today. Thank you all for coming. We really appreciate it. And the next decade is going to be really fun.
Thank you.
Thanks, Vanna.
Good afternoon, ladies and gentlemen. We're now moving on to US champion in rare earth magnets and battery materials. And I'd like to welcome to the stage David Wilcox, Executive Chairman of Evolution Metals and Technology Corp. Thank you.
Okay. Well, I guess I'm going to tell everybody about our company that went live on NASDAQ just last week on Tuesday. But first, I'm going to give a little flavor from what the last group was talking about, which is China's dominance in the processing side of rare earth and magnet materials. So, you know, going back to why rare earths are so rare in our market today is because China processes about 90% of all the rare earth material, the rare earth ore around the world, where they're mining for about 70% of it, they're importing about 30%. In the United States, we obviously have MP Materials, which is our only rare earth mine in production, very good company. They're about 12% of the global rare earth concentrate that's produced today. So we don't have a shortage of rare earths or rare earth ore, we have a shortage of processing. And why is that? Because primarily rare earth ore comes from a rock called monazite. Monazite is radioactive, has thorium in it. Under the Nuclear Proliferation Act and signers to that act, you know, you can't process and further concentrate thorium, which leads to a bottleneck, which has created this vortex that China has today. So if you look at all the refining capacity in the world, you're starting to talk about hydros, you're starting to talk about pyrometallurgy, you're starting to talk about neodymium, praseodymium, and then your heavies, which are terbium, dysprosium, and holmium. So there's 17 rare earth elements on the periodic table of elements. About 5 of those make up 95% of the value chain. So your lights, which are neo and preso, and your heavies, which are terbium, dysprosium, and holmium. As of recent, with our president and the geopolitical sort of fight that's going on between China and the United States, a lot of sort of escalations happened in the market. It's happened before. It happened in 2010 with Japan. But just recently, in October of 2025, China has banned any magnet material or rare earth material that's a heavy material of 0.1% or greater of heavy rare earths. So therefore, if you don't have the heavies, you can't make a sintered magnet. And that's what goes into a traction motor. Those are your high performance magnets. So you've got your bonded magnets, and then you've got your sinter magnets or your high performance magnets. There's been a bunch of escalating trade war sort of nuances in the space, which I'll go through here in a minute. But you know, your rare earths aren't rare, which you'll hear quite often. High-grade rare earth deposits, 5%. So you got 95% of other things that you need to get rid of or put back into the ground. So there's been a bunch of sort of legislation, bipartisan action, not just in the US, but across Europe and friendly or allied Asian countries. You know, a lot of this as of recent that I put up here, but it all comes down to the processing. The way China does this, the way they do it, you hear this word critical materials or the 2 words all the time. If you look at the cobalt market, almost all of it comes from Lumumbashi. Comes from a copper vein in Lumumbashi. You're looking at 30 to 50% grade in the ground. It's a hydroxide that's super sacked. It's brought over into China, and they put the residual of the material back into the ground. I spend most of my time in Idaho these days. Idaho doesn't want Montana dirt. Montana doesn't want Idaho dirt. Certainly in the United States, we don't want to be putting Congolese dirt back into the ground in the US. So to beat China, how are you going to do it? So where we start in our value chain is we started end-of-life materials because it's the low-hanging fruit. You look, there's about 1.6 billion people in China. There's about 350 million people, give or take, in the United States. We consume 3 times the electronics that China does. And China produces nearly a metal or a component in every single electronic that we use today around the world. So if you take those electronics, you take those batteries, which we'll get to in a moment, you can recover pretty much everything in a closed loop cycle. So this exists in the copper market, the base metals market, the precious metals market today. And so it's called closed loop refining or closed loop separation, and then turning that material back into a saleable commodity in the Western hemisphere. So we start with batteries. So you're going to discharge, dismantle, and then you're going to run into a shredder or a pulverizer. Start with end-of-life materials, electronics. You're going to throw those straight into a pulverizer. You don't want to throw your batteries straight into a pulverizer without depleting the cell because they'll explode. They're highly flammable. Then you're going to run your hydrometallurgy and your pyrometallurgy process. You're going to take that, separate it back out into your oxides. Your oxide material, you then would run into crystallizers to produce what's called precursor cathode active material, which would be the input to a gigafactory. In terms of a magnet, you're going to go straight into a metal, then you're going to alloy it, run your metallics, and your powder and flake if you need it, and then you're going to make a bonded or sintered magnet. The reason precious metals are up here is because you've got your base and your precious metals. There's a diversified smelter, world out there. That is not something we do as a company. We send that off into a diversified market where there's very strong price support. So over on the far right, the battery gigafactories, we have a view, and there was some commentary in the last sort of fireside chat discussion that why did gigafactories not work around the world and why have they worked in China and really not other places? Well, your input in a gigafactory is precursor cathode active material. So when all of these gigafactories spun up, China didn't sell us any material. So all of them kind of went empty, and people said, well, the adoption of EVs EVs didn't work. If you look at 23 to 24, EV production was down 50% year on year, where lithium-ion battery production was up 37%. So there's actually no correlation to EVs whatsoever in lithium-ion battery production. What do we do today, and where are we going? So we've got a complete mid and downstream in Korea, so we operate 4 factories there, run about 660 tons per annum. We're still growing and centered in bonded magnets, so finished products. Historically, we were buying oxide, metal, and alloy from China. We're closing that loop by building a hydrometallurgy facility and a U.S. industrial campus in the United States, which we expect to finish in 36 months. Currently today, we don't produce PCAM, but these businesses are correlated. And I've been saying this for many years, and there's a reason why. People say, why are batteries and why are magnets correlated? Well, if you want to produce a magnet, you need a little product called lithium fluoride. And where are you going to get your lithium fluoride to produce magnets in a very high capacity? So our phase 1 will expand to 55,000 tons of high temperature magnets and 78,000 tons of precursor cathode active material. Why that number is important, specifically for the magnets, the magnet business globally is about a 300,000 ton per annum high temperature business. And if you look at the next slide here, you've got 3 products, 3 separate companies, right? So the Apple iPhone consumes about 4,500 tons of magnets, so 1 product, 1 company. And then you've got the Tesla Model 3, about 4,250, just call that together 10,000 ton per annum. So if you're in the magnet business and you want to produce magnet material for, say, Tesla or Apple, what will happen if you can't take out 100% of their capacity is China will not sell them the rest. So you say Evolution is going to supply 1,000 tons of magnets to Apple. Well, the Chinese can turn around in the downstream and say, well, we won't give you the rest of them, and then you'll have a fall off of your product sales. So in terms of gigafactories, what I mentioned, 78,000 tons in planned phase 1. So these are just 3, so GM, Ford, and Hyundai in the United States. You're looking at 60,000, 120,000, and 45,000 tons. Like I said, 78,000 tons, we're starting to make a dent, but we won't reach 100% of capacity of all 3, so we'll have to pick and choose where we go. From a management team, I was a Deutsche Bank guy starting about 10 years in the making of building this business and spent a lot of time in Africa and the physical side. putting together a team of management like this has been, something very special for me. We have a former deputy secretary, Andrew Nags is our president. We have a former investment banker, spent a lot of time in the commodity space, specifically the thermal coal space, a pretty high profile lawyer, and an ex-CMO for Subaru, Hyundai, et cetera, that knows the automotive market very, very well. Our board is made up of some pretty high profile, the ex-Secretary of Defense for the United States in Trump version 1, Chris Miller, former ambassador for Trump version 1 in the Dominican Republic, Robin Bernstein, and then a very diversified board of investors, individuals that bring a lot to the table when it comes to national security and supply chains. So where do we look to be in the next 3 years, which is a global supplier of lithium-ion battery material, so precursor cathode active material. That's your inputs. We don't want to be a downstream battery manufacturer. And where are we going to get the feed material for both the magnet business and the lithium-ion business? Well, as I mentioned, there is an e-scrap world that's out there today. It exists in all ecosystems. But if you look at a piece of hardware such as a Seagate hard drive, you're looking at a pallet of hard drives. They're selling for about $2.40 a pound. Your magnet inside of it's worth, about $1.20. Your cost of extraction of just that magnet could be about $2.50. Why would you do that? You've got to make money in your aluminum. You've got to make money on the chip. You've got to make money on all the material, which is why this business has historically been sort, not separate, ship all the way to China. There have been numerous people that have tried to enter the space in lithium-ion recycling. There were 4 majors. One of them has gone bankrupt just recently in New York. That was absorbed by a company called Glencore. And why did it not work? Well, it goes back to the hydrometallurgy facility. The black mass is what they call it in the market. The black mass just ended up being shipped to China because no one has a hydrometallurgy facility. Why has no one built a hydrometallurgy facility? The CapEx is high if you want to build something of commercial scale. So our hydro will cost about $1.6 billion in CapEx to get going at the size that I've been mentioning now. And then where are you going to get the feed material? So if you're separating new material and you're not closed loop, you're going to need a tailings lake. You're going to need to be importing all sorts of ore all over the place. As I mentioned, Idaho and Montana don't want each other's dirt. So being closed loop, having a focus on U.S. government assets has been something that's been integral to our business model. So you look at classified assets across the United States, not just military-based, but really interagencies, and they treat them the same at their end of life as they do if they're still running, because they contain sensitive data and information on them. They're storing them in military bases, et cetera. And we have looked at that business and taking that material that today goes to incinerators, turning that through our closed loop system, re-beneficiating that material, using our capability of producing magnets and ultimately precursor. So as I mentioned, we started trading on NASDAQ on January 6th. We had a hell of a first day. We started trading at $10. We jumped all the way to 24. So a big pickup in the market. We've sort of settled currently, I think we're around $11 or $12 today. So a pullback, but we did not drop. Got around a $7-8 billion market cap. Our execution, as I said, today we take oxide, we turn it to metal, alloy, powder flake, metallics, sintered and bonded magnets, under 1,000 tons per annum. Customer base is very strong, U.S. automotive, Korean automotive, Korean electronics. In our final state, we're going to be combining all of this technology into one industrial-based campus. And what's different here is all of this stuff is commercialized. That was something I set out in the very beginning. I looked at new ore sources. I hope they come online in terms of being able to separate that material, deal with the thorium, deal with the waste streams. But in the interim, the low-hanging fruit is certainly the electronic and battery waste streams. So another difference in our supply chain, so you'll hear upstream, midstream, and downstream, is we can buy and sell material at each stage in the vertical, which even within China, this vertical is not stacked. And why everything's stacked against us outside of China really starts with the 13% VAT. So when we buy oxide or we buy metal from China up until just recently, we pay 13% out of the gate. So you have a 13-point differential behind companies within China buying and selling in each stack in the vertical. So it's really important to look at this in sort of a puzzle piece in each way that we can produce revenue and help build a supply chain, build an ecosystem for other companies that are coming online with new technologies, new capabilities, et cetera. But ultimately, we stop at magnets, we stop at precursor, we sell ore early on, or concentrate over to smelters when it becomes, or when it's for base and precious metals. The missing link, as I've mentioned throughout the presentation, is the hydrometallurgy facility. It's the huge lift. When you go to financiers, okay, you take in $1.5 billion, you take in $2 billion. Where's your feed material going to come from? Where's your offtake going to come from? Where's your certainty of finance? I view this as, a closed loop business similar to the copper business. 98% of the world's copper that's ever been mined is still in circulation today. There's plenty of this stuff above ground. So for our investors, for the market, for the feeling we have certainty that the hydrometallurgy facility will be a success. And that certainty comes with our operators. Our team's led, our CEO by Frank Moon. He was previously at ASM, an ASX-listed company. And prior to that, he was building hydrometallurgy facilities around the world, including within China. He's got a team of 11 PhDs and about 42 engineers that work full-time. We run most of the processes internally that are all commercialized today. So the key is the hydrometallurgy facility, and then it gets easier and easier if you know how to make a magnet, you know how to make precursor, you know how to make salts. As I was mentioning before, if you produce a black mass today, very similar to a rare earth concentrate, there's only one buyer. And the guys mentioned lithium. I was hearing a lot from the last group. Well, which stage of the lithium? Is it a brine? Is it spodumene? Is it a concentrate? What is it, right? So without that hydro, the black mass was always going to fail because China can just stop purchasing it. So if you're the largest lithium production company in the world, who's your customer? It's China, right? If you're a rare earth production company in the US, who's your customer? It's been China. The OpEx and the time to start up a mine is extreme. And those are great companies that are doing that, but our business we're not becoming a mining company. We're staying a downstream magnet producer, magnet material producer, battery material producer, and a midstream processor, not becoming an upstream mining company. So a lot of people, the president has rhetoric about rare earths and critical materials, every day almost. It's mainstream news at this point. There's been executive orders about licensing risk, things that the federal government's accelerating for putting, $1 billion plus into a project into the United States. So we fall clearly in that category. We have minimal permits because we're not cracking and leaching. We're not new ore material. It's all closed loop. But nevertheless, all of the things in the environment have made the United States very attractive for this business as of recently. So how do you compete with China? I put a few things, up here together, and, it really comes to, stacking the vertical, having a non-China price, a non-China product, and not having to be subjected to that VAT tax. There's a lot more that goes into it, but the success of the business is driven by the hydro because you've got to connect the vertical stack, as I keep on mentioning. Proven technologies, not new R&D that you're trying to figure out along the way, commercial scale technology that can run this business successfully. All of our businesses in Korea, our factories, have been running for quite some time. One of them we acquired. We're running for 18 years. It's a bonded magnet business that we acquired a number of years ago and merged all these businesses together. So this is just a summary of what China's been doing for about 50 years. And just as of recently, the banning of the exporting of the materials for terbium and dysprosium or heavies. But they've been doing this, making little nuances along the way, which make it very, very hard to end up producing a product that we can use in Western industry that almost every business, whether it's a healthcare business, an MRI business, an automotive business, an aerospace and defense business, everything's got a magnet in it. And people like to use the word, China weaponizes this business. I think they treat it as a very clever way of doing business as a country. And, we feel that we've unlocked an alternative to what's happened over the past 50 years. And what I'd like to close with is there's been, a lot of talk on how you can be the greenest, cleanest, company around, green energy, this and that, which I'm a big believer in. I'd like to think that our business, because we're closed loop, we're using everything that's above ground, that's already been mined, makes us a really compelling story for, I guess they've changed the wording, but a sustainable future, I guess is what I'd put up there at the top. So lots of high profile jobs, lots of interesting material that will support the next industrial revolution. We've got to have all this, and that's what we're doing, and I appreciate everyone's time. Thank you.
Good afternoon, ladies and gentlemen. We're now moving on to panel session regarding increased funding and focus on rare earth mineral exploration. Your moderator this afternoon is Sheila Karma. Thank you.
Good afternoon, everyone. My name is Sheila, and welcome to the next session, which is focusing on rare minerals and the importance of ramping up investment exploration to build up the pipeline of rare mineral resources, especially to counter some of the geopolitical imbalance with respect to those resources. With me is a group of panelists, Philip from the Geological Survey of Finland, Mel from the United States, Jose from Brazil, and Caitlin again from the United States. We are missing one more person who will join us shortly. Thank you very much for taking the time to be with us.
It's Abigail.
While we wait for the last panelist to join us, in the interest of time, I think we best get started. Let me start with you, Philip, since you're a geologist. Perhaps you can explain to us what we mean by rare earths, why are they so important to transition to clean energy and related technologies.
Thank you very much, Sheila. Thank you very much for inviting me, and hello panel, hello audience. Well, first of all, we discussed this yesterday. Rare earth minerals is actually a wrong term. Rare earths are not rare at all. They're very well and very common all over the planet. The problem is that they're very dispersed, and geochemically they're very similar to each other, which makes them, first of all, hard to separate. And the second problem is that they hardly ever accumulate. So we don't find major deposits of rare earth. And that is what makes them strategically important. Well, they are heavy metals, and we need them because they have very specific physical characteristics that are needed, especially in electronics. We're going to come back to that later. Now, as I said, they're called rare because probably when they were first discovered in the 1800s, they were so uncommon and so difficult to separate that the people just called them rare earth, which in fact later on we noticed that they're not. Now, where do we find them? We find them in some very distinct geological settings, but these are basically found all over the planet. Now, why do we then have some countries that produce them more than others? This is going to be one of the next questions, I believe. But I think it is particularly the energy transition and the latest development in defense industries and, of course, in the mobile sector, I mean, mobile phones and digital applications that make these minerals more and more interesting. Thank you.
Thank you very much, Philip. You've explained what they are and what they are not, and why we need them. I suppose the next question is, how did we get to where we were? A situation in which one region, one country pretty much dominates the supply of rare earth minerals.
I think this very much refers to the former speaker that we had, who I think gave an excellent presentation. It is China that took the decision about 40 years ago, and they took a strategic stance on we will have a rare earth element strategy. Now, I'm not aware of any other country on this planet that's actually ever developed a 40-year-long mineral strategy in any way, saying that we want to be the world leader in this particular sector of the market, and we will do everything to do it. Now, China is not blessed with an, as I said earlier, specific amount of rare earth elements. It is specifically this strategy that leads to it. What comes along with that strategy is, of course, as I explained earlier, it is very difficult to separate them. So you need a lot of energy to do this in the whole process. And secondly, because the rare earth elements are very often associated to radioactive elements, such as uranium and thorium, you have environmental impacts. And as far as I'm informed from the literature, that China has deliberately lowered these environmental standards, and we're going to come back to that later in our panel, in order to reach this domination in the market. Now, if other countries or regions would take up a similar strategy, I think we could soon talk about, like, do we have only one country dominating this, or do we have other emerging regions and countries, as we have heard from the former speaker, that might also enter the market with rare earth elements? Thank you.
Thank you, Philip. I'm now going to come to you. You are involved in making investments.
That's right.
And I wanted to get a sense from you of how has the capital markets evolved over the years in their approach, enthusiasm or lack thereof, of putting money in rare earth projects?
Yeah. Well, it's changed a lot, right? Through the years, I think it started as a very niche and opaque market with a massive discount when compared to what gold or copper or even iron ore was trading at. I remember in Brazil, where I'm from, we used to, maybe 7 years ago, used to find lithium in the mines and throw it away, discard it, right? And this has changed so much over the last few years. I feel like we've evolved and accelerated investor interest over the last 2-3 years now, where we live in a world of geopolitical mining, where you need to be aligned with sovereign interest or government-backed financing in order to make this work nowadays. But definitely it has evolved tremendously in its value over the last, let's say, 30 years, right?
And so where are we now? We know how we got here. What are you looking for? Is your perception of risk when you look at rare earth projects and your perception of potential rewards different from when you look at other mineral substances, or are all minerals the same from your perspective?
No. We definitely have two different focuses. Today we're a private equity, private credit fund out of Brazil, institutionally backed, and we have a very, very strong and dedicated mining strategy that within rare earths and critical minerals is investing in ionic clay mines in Brazil with a very high concentration of magnet elements, in addition to several other critical minerals like lithium, niobium, PGM, and others. But today, the issue here is not the mineral endowment. The mineral endowment is there. The difficulty is, how do you transform that endowment into a bankable project, right? And this involves a series of things where, for us as a Brazilian fund, is very important for us to partner with other investors around the world, so that we can be their boots on the ground with regards to permitting, which has been a critical factor in our investment decisions. Offtake agreements with governments, right? Today, if we look at the world and we practice the prices that are being practiced by China, then there is no other market, right? We need to create a market ex-China where pricing needs to be created from scratch. And this is through the offtake agreements that we've been negotiating as we go with different entities, different countries. And these are basically the main factors that we've been looking at. And obviously the processing, the separation partners, whether they're in Europe or potential projects in the United States that we're keen to explore. But all of these factors impact where we put our money in. But at this stage, I'd say it's a big leap of faith into the future.
Right. And so, Mel, you are in the United States and you serve on corporate boards. And one of the recent developments is that sovereign states, like the US, a place in which traditionally the government was separated from industry, are now investing directly in minerals, including rare earths. And I wanted you to give us a sense of how did we get here? Is this a fundamental ideological change in the way the world is moving forward? Or is this a temporary effort by the United States to bridge the gap between themselves and China in the area of critical minerals, but specifically rare earth minerals? What's going on?
Absolutely. Thanks, Sheila. You know, I want to harken back for a second to this matter of China already having a 40-year plan in place. They gave the first signal to the world back in 2011 when they shut off the critical rare earth spigot to Japan, and Japan successfully won a case in the World Trade Organization against China, so China was forced to retreat. That was a signal that the United States and everybody else, frankly, in the Western world, seemed to miss, that China had put a card on the table showing part of its hand. If the United States had begun responding in 2011, we might have a different scenario on our plate right now, but we did not. So post-COVID, the United States suddenly awakened to being, effectively speaking, in peril, because these critical materials are critical because they underpin the technologies that we all rely on. The building is stuffed full of them, our cell phones, our cars, etc. And this was instantly identified in the United States as a national security issue. Under the rubric of the national security law that has been invoked particularly by the current administration, the government actually has at its disposal sweeping authorities. And it is using those authorities creatively. President Trump launched a series of executive orders, essentially releasing the mining industry from the shackles of an onerous regulatory burden, which had kept the United States from developing a viable mining industry. That was a result, those regulations were a result of concerns about environmental, social, and governance impacts of mining. So they're perfectly legitimate, but they no doubt went too far. The administration also has opened the government coffers, and this is happening in a variety of ways. Different agencies, such as the Departments of Energy and Defense, have access to financing for projects which will support their objectives. Also, we have the Export-Import Bank with a new, more vigorous mandate. And most recently, as we saw with both the mining company MP Materials, currently the only American company in the rare earth space, and Intel, a legacy semiconductor producer, the government has gone one step further. Mr. Trump has said, as was just referenced, the private sector will never be able to beat China because China's companies have government funding and government support that United States companies did not. And that is what is behind the decision made by the Trump administration to begin the process of taking equity positions in companies identified as vital to American national security. Now, the first one was in the mining sector, the second was in semiconductors. This is a policy that's here to stay because the implications of this critical minerals conflict stretch through every aspect of modern economies in the United States and everywhere else.
Thank you. So there you have it. The world has changed. But I want to push you a little further, Mel. Is it the position of the United States government that the federal government will take an equity position in corporates in the United States, or will the United States also take an equity position in corporates outside of the United States with a view to accessing those materials to come to U.S. Industries?
It's definitely a logical second step, but keep in mind that each nation also has its own regulatory constraints. So, for instance, recently we saw in Canada that China's government was prohibited from taking a stake in a Canadian company. So the answer, Sheila, in brief, is yes. The United States may very well have an interest in taking equity positions in companies that are vital parts of a U.S. national security supply chain. But there is still that constraint that if the recipient country, let's just say Australia, if Australia decides that it wants to say to the United States, nope, we don't want you owning 15 or 20% of Linus, which is the champion rare earth company of Australia, Australia has the right to say no, at which point, of course, there begins a long conversation and a push and a pull.
So that is interesting, but we have the geoscientific aspects of rare earth, we have the investment aspects, and then we have the geopolitical. I want to come to the environmental. I want to come to you and try and look at the environmental and ESG aspects of mining rare earths. Very often when people speak of rare earths, they tend to associate them with a higher than normal environmental risk. And I wanted to get a sense from you, why is that? Are we overreacting? Are these substances inherently environmentally more risky than would otherwise be expected of other mineral substances?
Thank you for the question, Sheila. I believe that it's an oversimplification of the matter, and let me explain why. First of all, I think you first need to differentiate between responsible formal mining and informal illicit mining. Responsible mining, like companies such as the one I represent, Aclara Resources, or MP Materials, or Linus, or Serra Verde, use modern mining techniques, comply fully with ESG standards, and mitigate and manage any potential environmental impacts. A very different thing occurs in illegal mining, such as that which occurs in Myanmar or in other countries that have more lax or non-existent ESG regulations. So in that type of mining, and unfortunately, if you just simply Google it, you will see it, live images of it, you do see environmental degradation, you see deforestation, you see runoff of toxic materials into the soil, into the rivers. But that's illegal mining. Now, sadly, that illegal mining is not limited to rare earths. It also exists in gold mining. It exists in many other types of mining. So it's a problem that needs to be addressed, but it's not, it's like I said, it's something you need to differentiate it between illegal mining and formal mining. Another big difference is the types of rare earth deposits. You need to go back and differentiate. So you have hard rock deposits, primarily monazite rocks, and ionic clay deposits, and their impacts are different. Hard rock deposits usually have a higher degree of environmental impact just because of the nature of the deposit. To begin with, they're deeper. You need to use explosives. You need to grind. You need to mill. All that has a larger footprint involved. The metallurgical process is also different. Ionic clay deposits are much easier, just because nature made them that way, right? Over millions of years, the weathering took care of many of the metallurgical issues that hard rock deposits have to deal with now. So they're shallower. You don't require explosives. You don't have to mill. You don't have to grind. It requires a simple process to extract through ionic exchange the rare earths from the clays. And so all of that makes the whole process and the impact much less and much more benign. And so, and thirdly, I also believe that, as we've all said, and the past panel said it, radioactivity does exist in some degrees associated with rare earth deposits, but they also exist in many other minerals. And today, with modern technology and with the ESG compliant procedures and protocols, you can address it. So it goes back to being responsible miners, to applying the right technology, and to having the right standards in the countries. Obviously, in countries that don't have those standards, you see that type of mining that unfortunately gives everybody else a bad reputation.
Yeah, I must say I sympathize with your statements, because here we are speaking about mining as if it is homogeneous. Nothing could be more wrong. Mining of metallic substances and processing of metallic substances is vastly different from processing, say, gemstones. And so in many ways, this is our challenge, isn't it? That we converge around the concept of mining, all the while forgetting that the issues are very different. But I want to come back to you on the environmental issue, but especially ESG. So if one thinks about it, to mine responsibly starts right at the top with exploration to extraction, processing, producing of metals, and then right down to the consumer. If we get things right, we will be environmentally, socially, and from a governance perspective, responsible at each one of those stages. But if we do so, with every stage, the price of the commodity will go up. My simple question to you is, who picks the tab for the cost of the world being responsible miners, but also responsible policymakers, responsible financiers, and responsible consumers? Who picks the tab for the cost of ESG?
Again, an excellent question, and nobody has a clear answer. That's the big. It's no secret, complying with ESG standards requires substantial capex and opex. It costs money, simply put. And so the big question is, who pays for it? And we believe, and I'm sure that many around in the panel believe also, that cost either needs to be transferred or at least shared to the ultimate end user who uses our product. The market cannot expect companies to apply the highest standards of ESG that, like I said, cost money, and then have simply the companies, assume all of that cost. It just doesn't work. It may work in some countries, and I'll give you a small anecdote. Our project, Clara's project in Brazil, is called Carina. We had some executives from a country that I'm not going to name come and visit it. They loved the project. We are going to invest $680 million to put this project into operation. They loved the geology, they loved the project, but they were amazed at the capex. They said, look, in our country, we can put this into production for $50 million. It really, it really makes you wonder what type of compliance, what type of standards they must be using to be able to say that with a straight face. So that goes to, how can you compete with someone who can put a project for $50 million into operation when complying with all this technology, the standards that the modern world requires, requires $680 million. So, but I think the market's changing. I think the market's changing. I think the market is realizing that it cannot rely on its main competitor. So it needs to look for alternative supply chains that are independent, that are resilient, that are ESG compliant. I think that they've realized that the cost of relying on the main competitor, like what happened last year when China, put the export bans, is much, much higher than having to pay an increased cost for, again, a product that is ESG compliant, that is independent, and can guarantee a supply and traceable product.
Thank you. I'm going to come to you now. We have spoken about the United States and we have spoken about China. I think we do ourselves an injustice if we leave it at that. The world is bigger than those two countries. Let's just put that on record. And so, given that, my question to you is, what are the other global trends that we are seeing with respect to investment in rare earths? I mean, is it really just about Uncle Sam and China, or who else is in this game? And could they be, for all intents and purposes, a reliable arbitrator of geopolitical trade?
So definitely it's not just the two poles of the East and the West, the US and China geopolitically engaging on these issues. The G7 leaders this year released a critical minerals action plan that very much articulated that collectively they are not okay with the status quo, with the concentration of these supply chains. Obviously, we talked about how there is a lot of difference amongst the different types of critical minerals, but the rare earth elements got a specific call out in that action plan and more clear deliverables in the critical minerals roadmap that came out of the G7 ministerial. So you're seeing emerging action in Brussels, certainly a lot of attention. We've heard a little bit about this before from Australia on this issue, given the importance of GDP, and then obviously South Korea. So those G7 plus countries have really banded together. In terms of trends beyond the kind of awakening from our governments in this issue, the second one would be the dusting off of sovereign tools and maybe re-equipping them to get at the nut of this question. We've heard both of you guys talk about this a little bit before, but just to add and complement, this concept of government partnership with the private sector is definitely more pronounced. You're seeing a lot of equity investments. This began after 2011 with Japan in Linus and Australia, but now obviously in recent days feels like there's a different equity investment coming from the US all the time. And we're seeing creative approaches from other leading countries on this, on how to negotiate it through their export credit agencies, their development finance institutions, and with their own local incentives to drive attention towards their projects. And I'll just add to Mel's point and your question about, because I am based in the US, so I spend too much time thinking about the US, unfortunately, despite my Canadian accent. The US has actually invested in 4 different international critical minerals projects, providing equity, including in the Alcoa project in Western Australia. The Department of War put equity investment in that. In 2 Canadian companies, albeit operating in the United States, Lithium Americas and Sovereign Minerals in Alaska. And then the last one is here. Made in the US, MP have an agreement where they're putting equity in at about 49% between MP and the Department of War, Department of Defense, Pentagon, whatever you want to call it. And then Made in coming in, I think, at 51%. So you have seen this now international equity approach and partnership. And I think what will be incumbent upon allied players and partners in this space to really diversify the supply chain, because diversification is security, is really trying to creatively finance collectively so that we can get at the root of this problem. Please.
Abigail, but you've spoken about these partnerships that are going on, right? And what we see is that the endowments of mineral resources around the world are usually in countries where you cannot just go alone. You need to be able to partner with the right investor, the right people on the ground that are going to help you execute on the vision to guarantee that offtake, right? So investing only in U.S. companies abroad is going to be a challenge, right? You need to be able to partner. In Brazil, that's what we're seeing. Even the U.S. has invested a little bit with Aclara already, right? So these partnerships are really the key to unlock the potential ahead.
So let me follow up on that then and say, what alliances are we seeing then? If we are convinced that partnerships are the way forward, what alliances are we seeing, not just between a government and a corporate, but also between sovereigns? The Canadian government, in their budget, set aside a huge amount of money for a project in Ontario, in copper. The Canadian government is also talking to their European counterparts. What are we seeing in terms of those partnerships that you advocate for? Are they manifesting, and in what way are they manifesting? Are we seeing new friends and new adversaries? What's going on?
Yeah, you don't want too many cooks in the kitchen when you're starting to negotiate a critical minerals project and figuring out kind of who's taking on what risks and supporting what parts of the capital stack, right? And so to your point and building on it, we have the incredible capital price tag affiliated with these projects to get a new greenfield project built. So sharing that load is really incumbent upon different partners, obviously the local government, their national government, the sponsor government, and then the purchasing government, right? We tend to be inclined toward breaking the world up into buyers and sellers, consuming countries, producing countries. It's a little bit more complicated than that, but to have a successful project, you need to have someone buying it. You need that offtake side, and so we're seeing that emerge. I'll give you an example, just because it's top of mind with this Alcoa project. In Western Australia, it was the Japanese government that came to the Australian government, and then the Western Australian government and the Alcoa company based there doing alumina refining, saying, hey, we are anticipating a shortfall for our industry on gallium. And we're very concerned because simultaneously to this anticipated shortfall, we have major export controls that we're contending with from China MOFCOM related to gallium and getting that out of the country as a major producer. I think over 90% of the world's gallium comes from China in terms of not only the upstream but also the refining. And so they went to this company that produces gallium as a byproduct and they said, hey, we need this for our refinery. We're going to bring in the United States because after we refine the gallium, we sell it to the US semiconductor and industrial base, also defense industrial base. And so together you had the Western Australian government supporting it, you have the Australian government giving very historic amounts of $200 million, up to $200 million in equity. You have the Department of War coming in to provide equity as well. And then you have, I think quite importantly, the refiners and then also additional buyers between Japan and the United States. That deal is really hard. When I asked the Japanese government, would you bring in more players? Obviously, you have OEMs in Germany that really need gallium right now. And they said, to my point at the beginning, too many cooks is not going to necessarily get us to yes on a deal. And everybody wants quick, expedited deal making here because we're very concerned about security of supply and the flow of materials in a diversified setting. And so you have to keep it small between these kind of bilateral, trilateral, plurilateral groups, or mini-lateralism as it's emerging. And then you'll be able to kind of bubble up and hopefully at these high-level G7, Secretary Rubio is going to announce a new group probably in the coming days too, have maybe the policy set and direction for the private sector to follow and then come together more specifically in smaller groups around projects.
Thank you. Philip, as a geologist, you will tell us emphatically that these substances have been on the planet for billions of years. And yet here we are. Rare earths are now the darling of every mining conference. What is it about rare earths that has suddenly found itself in center stage? We've always known they were here. On some level, what is really driving this enthusiasm demand? Which technologies, if any, have changed that have suddenly thrown them center stage?
Thank you. As said also in the beginning, we've got three main drivers. The one that is mostly mentioned is actually the energy transition, because you need rare earth elements primarily for magnets, high performance magnets, and you need them in a very high quantity. So we're talking about hundreds of kilograms for each single wind turbine. So it is a substantial amount of these rare elements that we need, which was not there before we were actually relying on hydrocarbons. And this is changing rapidly due to political demand and also societal demand, as well as an overall threat of climate change. Then we've got, of course, as mentioned, digitalization, computers, mobile phones. So there's about 200 products where you need them for. And then one that is not mentioned very often is actually the defense industry. And we're not talking only about weapons. Of course, we've got more of them flying around, all of these drones, and all of these things need metals to be guided. But defense also means, of course, the entire IT infrastructure, IT protection. You need AI. AI needs a lot of energy. AI also needs a lot of magnets. So it's a huge amount of rare earths that are going to be demanded in the future. And if you look at every prospection, at least that I have found, the demand is continuously increasing. So there is a need to do what the former speaker has said. We need to increase the recycling, definitely on all aspects, but I'm afraid that the recycling will not be enough to satisfy the market, so we need further exploration into rare earth elements. So I think that the emerging now new markets that are coming up, investments here and there, and also the support, as already mentioned, the separation of rare earth elements is not easy. It is environmentally demanding and it is energy intensive. So we need also governmental incentives to support this development of new producers in order to satisfy the market. Thank you.
And Philip, you spoke about robotics, right? A little bit. We read about Elon Musk published that he expects to have 10 billion humanoids on the planet by 2040, right? 1 kilogram per humanoid. Can you imagine the amount of rare earth that will be demanded, right? Just
yeah, it's unimaginable. But listening to both of you, I'm reminded of two things that actually the entry barrier is not just access to the natural substance, it's also technology. And so I think it was the end of 2024 that the Chinese government passed a law in which they barred any Chinese entity from taking technology associated with processing of rare earth to use it in China. That creates already a barrier. And so I wanted to ask you, Mel, if you think about it, we have energy transition and then we have global security. To what extent is part of our problem here, not whether the United States and China are equally in production of rare earth, but that the world might find itself beholden to one country for the supply of substances that are critical to our everyday life? How much of this is about commerce, geopolitics, and just global security?
All of it. Because particularly now we find ourselves in a space where the decades of cooperation and free trade and broad alliances, that's over, brutally speaking. As we're moving towards a dog-eat-dog world, we're moving towards micro-alliances, and those are going to be fluid and shifting. And that's what's leading country by country to an emphasis on being able to develop a so-called national secure supply chain. And even though elements within that supply chain are going to have to be sourced globally and funded globally, they are also going to be regarded as national assets. And in a time where we are spinning further and further apart, this dynamic need for all economies to grow, for citizens to thrive, for defense mechanisms to be ready for deployment at a moment's notice, those are going to provide serious constraints over time on the ability to fund cooperatively projects. It risks the rise of the strong and the fall of the weak, and the subjugation, therefore, of the weak. So it's incumbent at this moment when we are transitioning for countries to clearly see where their mutual advantage lies, build partnerships that focus on competitive, cooperative advantage. In other words, every country doesn't need to build 10 processing facilities. It's tempting because everyone looks right now at the current situation and says, China's dominance arises from the fact that it processes 97% of the rare earth in the world. Therefore, we must all have processors. No, not so. Countries are going to need to make choices. Does your infrastructure support processing? Yes or no? Does your society support processing? Yes or no? And if the answers to those two questions are no, stop dreaming. Instead, find yourself a partnership with a country who has answered yes to those two fundamental questions. Build that strengthening alliance recognize where your advantages lie, and essentially sell those to future partners.
Thank you. Yeah, it's easier said than done. It's short of it.
Oh, yeah.
I have just 1 minute, and I'm going to leave it with you.
Okay.
So after all that, how realistic is it to think of global ESG standards with all the differences that we have already acknowledged? That you got 1 minute.
1 minute. Look, I start from the premise that global, what you're referring a new ESG standard, I don't think that really works, to be honest. I think that I go back to my original answer, which was there's a difference between formal mining and informal mining. What happens in the real world is that the informal miners continue to do what they want, don't comply with any of the ESG standards, and the formal miners are stuck with an additional layer of regulation. I think the regulations already exist. I think that formal responsible mining companies like the ones I mentioned fully comply with them, and they will continue to comply with them, not only because it's the regulations, but also because we think it's the right thing to do. We think it's the right way to do mining, to do it sustainably, and to really be environmentally responsible and socially committed. So I don't think regulations is the way to go. I do think, and I take this a minute to congratulate the organizers of this wonderful event, that events such as the FMF serve a very important purpose, to share ideas, to talk about experiences, to maybe form these mini multilateralism relationships that are the way to solve a major problem for everybody. Thanks.
Thank you very much. Well, thank you very much for your time. So nothing would please me more than to not tend to the audience and engage. I can't do that, and there are two reasons. The first is that I've run out of time. Now, that's a big deal. The second one is that actually the audio is not so good. You would barely hear us, and for that I apologize. But I do want to take a moment to thank all of you for being here, because can you imagine us talking to ourselves? That wouldn't be fun. But more than that, I hope you have found the conversations here very informative, and thank you, and a round of applause for my panelists. Thank you very much.
Good afternoon, ladies and gentlemen. We're now ready to move on to our next session, which is a case study in regenerative mining. Please welcome to the stage Rob McEwen, Chairman and Chief Owner of McEwen Inc. Thank you.
Let's see. Okay. Well, let's go. Good afternoon. Today is the right time for metals. It's the right time for Saudi Arabia. And it's the right time for Saudi Arabia to put forward a new model for mining. And I want to talk about regenerative mining, but before that, I'd like to just talk about where we are in the market. And this is just looking over the last 55 years and looking at commodities relative to equities. And you can see over on the right hand side rather, that commodities are at the lowest point they've been in 55 years. It's cyclical and it's poised to go higher. Now, looking at mining stocks relative to the global equity market, they're very inexpensive. They represent only 2% of the total equities deployed in the world. So, but if you go back to the 50s and 60s, you can see it was up at 11% rather than today at 2%. And I'm going to suggest to you today that we're going back up towards 11% in terms of the values of mining stocks relative as part of the global equity picture. So that should make you happy if you're in the mining. Now, this is just looking at copper from 2010, and it's on an upward trend, and you've heard a number of speakers while you've been here that the use of copper is going up and the demand is there, and there's a projected shortage. So you might want to be looking at copper stocks. Now, here we're looking from 1990 at copper relative to the Dow, and with the demand projections, I would suggest the copper is shown in the orange, that it's going to catch up to the Dow. And again, another reason to be in there. I grew up in the gold market, and I've been a big believer gold is money. And over the last 129 years, you've seen 3 occasions where 1 or 2 ounces equaled the Dow Jones. And we're on a projection to get back down to there again. About 5 years ago, I said gold was getting to $5,000. My next target, because I think 5,000 is very close at hand, the next target is $7,500 an ounce. And you can find people much higher than that at the moment. But it's an integral part of my portfolio, and I think it should be of everyone's portfolio to protect their wealth. Here we have, going from 2006, looking at the Dow and gold. And gold's outperformed the Dow over that period by a factor of 2. Now, this is looking at the gold sector. If you're interested in where do you put your money in gold, it depends on your risk profile. But you have the gold, you can see it's up. And then the GDX is an ETF of senior gold stocks. The GDXJ is of juniors. And when you get into a gold bull market, it's the juniors that are the Ferraris of the market. That is where you get the performance. You have to endure some risk, though. But that's my favorite area of the market at this time in the cycle. Now, this is a time Saudi Arabia has the opportunity to create a mining image that becomes a model for the world and is environmentally sensitive. But you have to dare to be creative, break the concept, change the perception of mining that most of the world has of mining being dirty, dangerous, and destructive. There's lots of examples today, and I'll show you one very prominent one, where reclamation has occurred after an environmental damage of serious proportion. But modern mining today is much more responsible and sensitive to the environment than what we've seen in the past. And we have to be looking at changing the public's perception to gain the acceptance to build, because if we don't get the acceptance to build, modern society as we know it will run out of materials to maintain it. So, can you create beauty in the place of just a scar in the environment? So, this is a picture of NASA's astronauts going to a place in northern Canada called Sudbury. It's a very large nickel-producing area. In 1971, NASA took the Apollo crews 16 and 17 to Sudbury to look at the rocks. Sudbury was a meteor impact site, and the rocks in Sudbury are similar to the rocks on the moon. But Sudbury got the reputation of looking like a moonscape, and that's what it looked like in 1981. There's a number of nickel mines. They were pumping out sulfur dioxide, creating acid rain when the fumes mixed with the precipitation. It looked pretty bleak, and you can understand why NASA went there. This is 2008 in the lower right. There was 8,500 hectares that they went in and put lime on, grass seed, and planted over 10 million trees. And so you can see the contrast. And this is going back to that period, 1980, and that's the same period from 1970 to 2008. If the astronauts came back today and didn't have GPS, they would not be able to find the rocks they were looking at earlier. So, I'm going to talk about a company that had no imagination. They had a huge environmental disaster, and they could have changed their reputation in a very large way. This is the smokestack in Sudbury. It's no longer used. I have a school in this city, an architectural school, and we worked on a project to change that smokestack, that disused smokestack, into a beacon of hope. And this is what the beacon of hope would have looked like. Clad in solar cells, a crystal observation deck at the top, a restaurant, that's the observation deck there. And it was really sad because this, if you looked at it, there was an opportunity. This company, MinValley, had a tailings dam that broke and cut many billions of dollars off their market cap. So this smokestack, we said, well, we could strengthen its structure, we could put a museum in the bottom, we could talk about the reclamation that occurred in Sudbury and how the industry is doing this globally. So this smokestack is quite tall. It's it's only less than half the size of the one that the building going up in Jeddah, but it was an icon. And it just confounded me that the corporate structure was unable to grasp that we have to change our image to be accepted in the world today. And this being the beacon of hope, not only for the company, but for the industry, and saying it's changed its ways. So I'll leave them alone. I'll just talk about my company, McEwen Inc. We have operations spread through the Americas. And I'm going to talk about our copper project. And I think if the volume's loud enough, you'll be able to hear this. This is looking at creating a regenerative copper mine that is light on the environment, using less than a quarter of the water, emitting 1/10 the carbon, having no tailings, having all renewable energy to power it.
We need to transform industry.
Maybe I need a back room to get some power. But you can read that for a moment.
Is one resource that will only grow in importance as we replace fossil fuels with a decarbonized world. Electric cars, wind turbines, batteries, solar panels, and the computers that power everything all require copper. And that copper needs to be green copper, carbon neutral and ecologically responsible. When we started the project, we began by drafting a set of principles for the project that would guide the team in its decision-making and approach. We did this work informed by the place itself. The Andes are an incredibly beautiful and sensitive ecosystem, so we knew it was our duty to be stewards of this place, protecting habitat, glaciers, water, and life itself, while at the same time getting the copper resources that we need. So we've been thinking carefully about the future first and our eventual legacy. We then focused on the people, the miners, and the community itself. And we've been working to create a new kind of experience for people that live in San Juan and the surroundings. Over the life of mine, over 1,000 high-quality local jobs will be created. And these will be jobs unlike any others in the industry. We think people will covet working for McEwen Copper because not only do we focus on safety, but also on dignity and livability, creating a mining facility that is an oasis in the sky. Here is our vision for the mine camp of the future. Beautiful, inspiring, and bold. A biosphere of health and life. After a long day of work, our people will return to a place completely powered by the sun and creating ideal conditions for rest, sleep, recuperation, and the daily needs of miners. Imagine a place that grows its own food, collects and treats its own water, and generates energy without emissions on a giant solar super roof. We are placing specific emphasis on indoor air quality, acoustics, and stress reduction with a focus on social justice, equity, and even beauty within a mine setting. This will be a place to live and thrive while earning a living. We're designing an ecological water treatment valley that not only completely protects downstream water quality, but allows for the creation of new habitat and the enhancement of vegas. Partnerships with local universities and scientists will see new advances in natural phytoremediation, water treatment, and ecological testing to ensure that water is always pure and healthy. Our entire mine operation will be powered by on-site and off-site solar farms, generating all electricity without carbon emissions. Wherever possible, conveyors and fleet facilities will be electrified and plugged into this network of clean energy with batteries instead of diesel for backup generation. At Los Azules, we are not building a mill. Instead, we are advancing heap leaching techniques to extract metals chemically and in a completely closed-loop process with radical reductions in energy and water requirements as a result. And finally, a state-of-the-art, renewably powered electrowinning facility will produce pure copper, so that from the pit to the product, our investors and customers know that sustainability informed every single step, and they can count on that for their own ESG goal setting. Our planning process continues, and we look forward to sharing more innovations as we develop this amazing project further. At McEwen Copper, we are striving to deliver the world's greenest supply of copper in the world's first regenerative copper mine.
What you saw there is what we believe is one of the models for mines of the future. One that is environmentally sensitive, has beauty, and generates a return, and is accepted in the community, isn't shut down like Cobre de Copper in Panama. It isn't denied before you can even put a shovel in the ground. We have to be understanding the community and adding to it. We're also looking at building a hotel there, not just for the families, but it's a gorgeous part of the world. You go there, you're close to the stars at night, you can almost touch them. The landscape changes color all through the day, and my camera is full of pictures of the same site every time I go down there. But you want to protect it. But it doesn't mean you can't make money doing this. So we did well, when we started moving it forward, McEwen Inc. is the parent of McEwen Copper. It's listed in New York and Toronto. This was as of the 7th of January. We were up 500%, but we're up 750% today based on current price. And that's in the last 36 plus months. Our feasibility study, it's the 9th largest undeveloped copper deposit in the world. It would be in the top 20 when in production. At $4.35 a pound, it was had a net present value of $2.9 billion. But as you know, copper price has gone up from $4.34. This project is every 10% move in the price of copper changes the net present value by $1 billion. So right now, with copper at just over $6 a pound, copper's 38% higher. The net present value has gone up 134% to over $6 billion. And if we get a doubling in copper, it's then $13 billion NPV. So a lot of leverage. So you can make money, but you can make it beautiful. And that's what the industry needs to do. Thank you.
Water? We need one more water here. Oh, no, that's fine. All right, welcome everyone. We're going to start. We've got an amazing lineup of expert panelists for you today to cover the topic of startup, and next generation technologies that will redefine the future of exploration. We're going to walk through a very quick intro for all the speakers. Then they're going to get into a little bit on their expertise. Hopefully we'll have some debate and banter and questions from all these expert panelists, and then we'll finish strong. So we thank you all for being here. Start with myself. I am Jim Paterson. I'm a principal of an exploration house in Vancouver, BC called Discovery Group. In the last 10 years, we've invested, our member companies have invested about $300 million into mineral exploration. And with that, gladly, the shareholders have benefited because member companies have generated about $2.5 billion in accretive exits. I'm currently now a director of a company operating in the kingdom called Sun Peak, and we have a booth here under the title Saudi Discovery Co. What's really important in terms of a competitive advantage is new technologies, and we'll take any competitive advantage we can get as a group. So we're really excited to hear what the panelists have to say today, get to know them a little bit better and their ideas. We'll start with you, Scott. That's all. There we go.
My name's Scott North. I'm the co-founder of Yeti Ventures. Yeti is a fully integrated discovery company. We'll leave it at that.
Thank you.
My name is Flavia Tatranardini. I'm the co-founder and CEO of a company called Fleet Space Technologies. Fleet is an Australian-based company with global reach, so we got offices all around the world and here as well. So we are a space exploration company. So we have a constellation of satellites that move data in exploration from geophysics information into the cloud to give an edge to exploration with technology. And yeah, we work a lot here in the kingdom. We also have a booth. If you like space and Earth,
thank you.
Come and say hello.
Thank you.
I'm Dave Goddard. I'm the president of Hexagon Mining. We provide optimization tools for mining companies to address optimizing the value of the asset underneath the ground over the life of the mine through advanced planning products. And we optimize a day in the life of the mine through our operations technology portfolio, fleet management systems, and safety portfolio, including collision avoidance and operator fatigue detection systems.
Thank you.
Good afternoon, everyone. Thank you for having me. It's a privilege to be here. My name is Irina, and I'm a head of XCarb Innovation Fund, which is a corporate venture capital fund of ArcelorMittal. ArcelorMittal is one of the largest steel and mining company present globally, and it's really the industry I'm very passionate about, and this subject really resonates because Innovation Fund is exactly about bringing some of the most startup and disruptive technologies to decarbonize steel making value chain. So look forward to our discussion.
Thank you.
Hi, good afternoon. My name is Hirofumi Katase. I'm Executive Vice Chairman of iPulse. iPulse is a company using pulse power technology and develop disruptive technologies in the area of various areas, for example, in mining, in the rock crushing, drilling, exploration, and shaft building, for example. My original background is I have been Japanese government for 35 years, and I have been a top official in the area of technology, space policy, and startup policy. So I'm very much looking forward to having discussion today. Thank you.
Thank you. And I mistakenly said the future of exploration, but you're right, Katase, the future of minerals. So the entire value chain, and hopefully we'll be talking about that today. Scott, with your mic down there, do you want to start telling people why you're here, your expertise, and what you're interested in this topic?
Yeah, no worries. So we, at Yeti Ventures, essentially what our North Star is we want to change the unit economic costs of discovery. Now, how we do that, we're going after the main cost line of exploration, and it's around drilling. So we believe if you build the right technology stack, and we're acquiring technology and building out that stack, that brings down the unit economic costs of drilling. And you do that many different ways. But essentially, if you can drill cheaper and faster than anyone else, it opens up new frontiers and it opens up new search spaces. So we're here we've just started the company, so here to raise capital, but then also educate people on what the possibilities are if you actually go out there and change the unit economic costs of exploration.
Excellent. What do you think, Flavia? Can you add to that?
Exploration. So it was always me and my co-founder dream, and now all the team dreams to change the way exploration is done. As I always say, we need to, as you heard in this conference, we need to find so much copper in the coming years compared to what we have found as humanity in the past 1,000 of them. And it's not just that it's expensive, that I agree with you. It's also long. It takes in average 15 years to find a new mine. We have done 5 million drill holes as a society in the past 10 years, and 0.1% of them found a deposit. So it's low, expensive, and inefficient, and that's okay. It's been like this for many, many years. But now the industry is under a lot of pressure. We need to find many, many deposits in a short period of time. So something has to change. Our assumption is that we need to work with data way more. We need to drill where we know the subsurface, and we need to make sure to create a way of working that we call agile geoscience that is a little bit faster. So instead of being in a tenement for 40 years, waiting to see if finally you find something, having the ability to be in the tenement with geophysics, geochemistry, geology, and having real-time decisions. So it can take you months to understand if the tenement is worth it to stay or you move on. And the way we have done this is building a satellite constellation dedicated to mineral exploration. We are the only in the world. Then move data from geophysical sensors on the ground into the cloud, where the data get brought together, and in real time we can give you a 3D map of the subsurface. So why we're here, because we work with Ma'aden, of course, with their amazing big challenge on having to find a tier 1 deposits of copper in the next 4 years in almost, 100,000 square kilometers of tenements, big challenge. So by using satellites and real-time decision, we can scan tenements much faster and realistically eliminate faster 90% of the tenements where there is nothing. So Fleet is now 10 years old. We are heavily VC-backed. It's probably the company in the world that raised more VC money. VCs in Silicon Valley now interested in mining, so that's good. It's good because finally we have investment in technology. So this is what we are passionate about. Next year we are launching our technologies on the moon. It's going to be the first analysis of the subsurface on the far part of the moon to find water. So yeah, pretty cool stuff.
Okay, we moved from the moon to Denver.
Yeah, I mean, it's a long trip, but worth it. The reason that Hexagon is here is 2 years ago we signed a partnership agreement with a very important customer of ours, Ma'aden, to form the world's first digital mine. And what that means is that we have an end-to-end technology solution set that addresses all parts of the mining value chain. And we're partnering with Ma'aden in order to deploy those in a manner that is unique and probably leapfrogs a lot of the production capabilities and technology capabilities of a traditional mine. And so we've been here for the last 3 years, super excited. And one of the things that we recognized is that it's one thing to support your customer and to partner with them in order to deliver value. But in order to deliver that value, what you need to do is you need to build an ecosystem. And that ecosystem has to include the universities and the students and the talent pool that will be feeding into your customer base and actually using the tools and helping them to extract that value. And so we've signed over the past couple of years, we've signed agreements with King Saud University, with King Fahd University, and next week we will be signing an agreement with King Abdulaziz University in order to make sure that the students that are studying mining in the kingdom are getting access and experience using the tools that are used in industry today, so that when they go out and they work for a company like Modern, then they can be digital natives. They can go out and they can be immediately productive in the environment that they need to be productive. One of the really cool things that we're doing as well is providing them those tools, and we're providing internship opportunities for these students as well in partnership with Modern. And so that's the reason why we're here. We're helping to build an ecosystem. We believe in what the kingdom is doing, and we want to base our regional hub for innovation in the Kingdom of Saudi Arabia.
Amazing. Thank you.
The reason I'm here, first of all, let me start by saying that I'm very passionate about steel industry, and you will ask why. Steel is incredibly versatile material. It's infinitely recyclable. It doesn't end up in the oceans. It's absolutely fundamental for the energy transition. So when we speak about energy transition, be it electrical vehicles or solar panels or wind towers or low carbon infrastructure, you need so much steel. So that's great. I mean, steel is a great material. But what the challenge is? The challenge is that steel industry accounts for just below 10% of CO2 emissions. And the industry, I think generally metals and mining are not known for innovation. Quite often I get defensive when people say, you're not innovative. It's just something, it's an old process. Steel is produced very similar way it was produced so many years ago. And I think this is an opportunity for us to actually tap into what you were saying, innovative ecosystem, and identify some of the most innovative, disruptive, breakthrough technologies that can help us decarbonize the steel-making value chain, make industry much more efficient, address the challenge of deficiency of some of the materials. So I think it's an excellent opportunity to make an impact by supporting some of the most innovative technologies. And that's what X-Carp Innovation Fund is about. So we launched the fund 5 years ago to support some of the most interesting technologies. We made close to 10 investments across the value chain in the technology, starting from the core of steel making, such as direct electrolysis of iron ore, but also across the value chain. And that's the reason I'm here. And I want to also, another word I picked up what Scott was saying is educate. Because the industry image is not particularly attractive. Quite often, if you speak to students and you ask them where do they want to go as they graduate from the universities, very rarely you will hear someone saying, I want to become a steelmaker, right? Everyone will, wants to work on space, on electrical vehicles, open AI, etc. And I think that's a shame. Well, it's not a shame, but it's it's an opportunity to also frame and educate and ensure that people understand how fundamental the industry is and how exciting it is to actually work on some of the most largest challenges in material science and the way the steel is produced and in the whole value chain.
Thank you.
So the reason I'm here is that IPulse is developing various technologies to solve the issues related to mining all through the value chains through our core technology called Pulse Power. Pulse Power technology is basically discharging electricity in a very, very small time. For example, there is a battery in my watch. But if you discharge this energy in 1 millionth of a second, you'll be able to obtain 1 gigawatt, which is as powerful as the power coming out from the nuclear power plant, but only 1 millionth of a second. And this technology originated from the defense sector, but IPulse is the only company deploying this technology to a wide area of civil applications. On mining, for example, we have already commercialized transmitter for called Typhoon, and this transmitter can survey 5 or 6 times deeper the conventional transmitter. And this is a technology which has found Oitorgoi mines in Mongolia, which is one of the 5 biggest copper mines in the world. So this is on exploration side. And on the development side, we are developing drilling technology, combining the conventional PDC drill bit and high pulse power. And we are successful in reducing the drilling cost by up to 70%, 70%. And we are planning to start drilling this year. And on rock crushing, as you know, rock crushing is the process that is consuming 4% of the total global electricity. And we are now developing technology to reduce the energy consumption by 80%, 80%. We have already a collaboration with the Kingdom of Saudi Arabia, with Marden, on the Typhoon technology. And we are looking forward to deepen the collaboration in this country as well, and also with all participants. So this is why I'm here. Thank you.
So there's this great range, the value chains right here represented on stage. Scott, whether you may need to leave early, so I'm going to get you on your question right now, and hopefully it'll spark some discussion. So what do you think needs to fundamentally change to make a tier 1 exploration success and discovery possible?
Thanks. I think, starting off, you need the geology, right? That's fundamentally, if the rocks aren't there, you're not going to make that discovery. But to find the right rocks in the right locations, we need to look at maybe outside of the industry of what others are doing. So looking at oil and gas for some inspiration. There's plenty of technology that sits in the oil and gas field that can be adapted to mineral exploration. And then that leads into data, real-time data to make real-time decisions. You know, at the moment, you drill a hole, you get some core, it goes and it gets assayed at the lab. There's a 4-week turnaround time, 4 to 6 weeks. What if you could drill, assay in real time to get a continuous feedback loop? That just speeds up your ability to test the ground. And I think the way that exploration companies normally are set up, fundamentally, they're not set up to drill to kill. And that's how we should be going after exploration. At the moment, we drill and hope we hit so we can raise more capital off the back of that. So I think if you have real-time data, that gives you a real-time feedback loop, and then you can make quick decisions. The last bit is capital alignment. I think, especially for exploration companies, the people that are funding the exploration companies have real short attention spans ultimately. And they want to see results next week, next month. But to do real geology, you need years, not weeks. So aligning those things and the rocks, I think it'll increase your chances of success for a real tier 1 discovery.
Let me jump to Irina, because I don't think you have a short attention span. And when we talk about capital deployment and having short-term demands, I mean, you take the longer-term approach and identify companies and innovations that will have a real impact. Can you talk about that?
Of course, I think that's, I mean, you have to, right? It's not the industry. I think I was given the example earlier when it comes to some disruptive technologies, say in software or AI, it's almost instantly, if you identify something disruptive, it's pretty much instantly you can roll it out and implement and scale it up. In our industry, if you find something potentially disruptive, it's like 10 years, 10 billion down the road before you can establish if the technology is technically viable and, more importantly, industrially scalable. So you have to have this long-term vision. You have to have the patience and the long-term horizon. As you know, I personally, we're discussing, I have sometimes a short-term span, but it's important to really have this approach that this is going to take a long time before we get there, but nevertheless we need to move now. So what we do with a lot of startups, we come up with a roadmap once they achieve certain milestone that we can support them, and in that way we can plan the long-term way accordingly.
That's great.
I think,
Dave, you want to jump in?
just, reflecting on the question of how, and some of the comments, in my mind, the real-time data doesn't necessarily reflect a real-time decision, because the decision has to be on the investment horizon, and I think that goes back to what is it going to do if I'm a mining company to make me feel comfortable enough to make that $1 billion investment, and the time frame over what you're gathering the data, and to make that decision is going to be necessarily long. And even after making that $1 billion decision to go and invest in this property, at that point, then it's also going to take time to construct and so forth. And so I think while there is a desire to put things on a millisecond or a second by second information gathering, and we can make decisions on it, I think is the risk tolerance of the industry is such that we should be looking at how do we have more accurate information, how do we have more relevant information in order to facilitate that longer term decision making, rather than focusing on we can do things instantaneously.
Flavia, I saw you kind of smile when Dave was saying that. What do you think?
I think that real-time data, real-time insight is very, very different. Real-time data is a technology problem. Like, how can you get real-time data from every asset in the middle of nowhere? So that's one problem that is tech. Insight is very different. I agree with you. Like, you can have all the data you want real-time, but so what? Now, to get real-time insights, machine cannot do it just by themselves, because this is the strongest AI system in the world, and it's still very important. For example, in exploration, when we gather data, and we do this amazing 3D map of the subsurface where all data come together, and you sprinkle AI, it's all the magic. Is this enough for someone to look at this 3D map and say, I'm going to invest $6 billion in this tenement because I see a copper? No, you still need to drill. You still need to drill a lot. So it is always thought that accelerating sometimes feel really daunting. Like, we are still ready the first part, and then the second part is slow. So it takes 15 years to find a deposit, 15 years to build it. And we're like, okay, maybe we now have increased the 3D mapping, decreased from years to days. But the rest of the system is still very slow. Mm-hmm. You need to chew the elephants piece by piece. You're not going to fix it all together. So what we really focus our attention is real-time insights, and humans have to be in the loop. Humans have to be in the loop. AI will not be able to make all the decisions by itself, I can tell you. What really fascinates me, and I think people that love technology will understand that, is the magic that happens when you try to decrease the time to do something. If you got infinite time, you just don't push technology enough. So when the first year fleet, we were telling our geology team, we would like to give an insight on the tenement in 48 hours. Usually, by the time you got a tenement, you put sensors on the ground, you gather data, and then data is on Excel, blah, blah, blah. It's a 12-month process, right? And then they need to make the decision, as you said. So all my geologists were like, why do I have to do it in 48 hours? Like, from 12 months, maybe we can do it in 6 months. 48 hours is going to impact a part of the decision. You know what happened when we forced 150 people to build technology to allow knowledge to happen in 48 hours? We changed everything.
Yeah.
We changed the sensors. We eliminated noise. We created AI. We automated everything. Like, they spent 1 year complaining, saying this is impossible. We can't do that. And then suddenly, because the technological constraint was so strong, the efficiency went out of the roof. So my 2 cents in this is that when you create a constraint in which decision needs to make fast, the system, the ecosystem around adapts, and you have to put technologies everywhere. So in our case, we needed to connect all the sensors to space. So when someone is in the field, like when you have a drill in the field, you go 48 hours by the time you have to move the next drill. That's it. Or you go home. Or you just keep doing things without not knowing. So in 48 hours now, you can actually be informed of what you have under your feet and change. And I can tell you the environment of speed is a technological environment. If you love this concept, I suggest you to watch a documentary about Spotify. You all have Spotify? It's on Netflix. Spotify CEO was forcing his team to change the internet. So that every time you look for a song, it appears straight away. What a weird concept. So they had 1 second delay, didn't want it. So they had to change the internet protocol. So why Spotify is so good? Because they changed the internet protocol. And that technology changed many, many other things. So I love that about speed.
Okay. Katasi, you had a point you wanted to raise. Thank you.
So I agree that IT or AI will certainly help. But if you base all these technologies on bad data, it will lead to some wrong conclusion. And I think everybody in this room has experience asking ChatGPT and they answer something very plausible, but this is totally lie. And this could happen. So I think what is as important as AI and IT is to improve the data acquisition itself. And that's where IPAS is doing. And we have actually discovered Oitologoi, where the BHP could not find any copper ore body, spending $400 million. But we found it, the Oitologoi, in a matter of a month by this technology.
I mean, I can also comment on this point of speed. Can't agree more. I think one of the key challenges for me is actually to marry the speed of traditional research and development team with the venture pace. And I think this is where you see lots of challenges, but I think, I'm quite optimistic you can increase the speed of innovation if you try to, put it in the ecosystem and get the teams to really collaborate and cooperate. But in addition to AI, for me, I think from the steelmaking perspective, there are 2 key points, or 2 key aspects we focus on. One is how do you valuably, economically, viably extract valuable minerals from the waste from steelmaking operations and from the byproducts. So I think that's one of the key technological challenges. And there are some interesting technologies we have identified in the space. And the second one is investing in some of the technologies that can help us utilize low-grade iron ores, such as, there are technologies for beneficiation, but also direct electrolysis. Actually, in-house, we have developed a low-temperature electrolysis of iron ore technology that has a huge potential to produce steel in the most sustainable way, just using, you don't need the blast furnace, you don't need the coke operation. It's really the electrification of the process and presents a great potential.
Excellent. Well, it looks like in the last sort of 5 to 10 minutes, let's just go down and you've all had some great input here and some thoughts. What do you think is the fundamental aspect that needs to change to really incorporate these kinds of startups and next generation technologies into really changing and impacting the sector? Start with you, Fabio.
People.
That's your number one? Tell us about that.
Implementing technologies they fail most of the time, new technologies. Unfortunately, it's what it is, but they can be absolutely impactful. So if you think that you are acquiring a new technology, I'm going to buy this technology, it's going to work. That's the usual approach. It doesn't work this way. You need to partner with technologies. You need to invest. So it's changing, but the old guard, they think, I'm going to use something in mining just if it works. Well, the reality is, nothing works when you try it new. So you need to be in the field, you need to iterate. So we just need to be a bit more tolerant to failure, and then we can achieve big success.
How about you, Dave?
I would say that the global mining community has a large number of technology orphans. Technologies that were deployed as a silver bullet, technologies that were thought to be the solution. And without the people and the process support behind that, none of these technologies are ever successful. And so I think you need to, the gating function really is, number one, people, talent that understands what the technology can and can't do, and appreciates it for its value of what it can do, rather than focusing on the limitations of the technology. The other part is a willingness to change workflow in order to adopt the technology. If I go back to one of the earliest technologies that I was involved with, it was the utilization of GPS and positioning technologies in order to facilitate ore control on a shovel. This was back in 1995. And before that, they had a geological or a geo division that would go out and put stakes in the ground and do flagging in order to differentiate the ore blocks out on after the blast. Very dangerous job as a function of the going out there in rocky terrain, uneven terrain, and twisting ankles and breaking legs and things like that. But that was what they had to do in order to differentiate. Once you could differentiate on a computer screen in the shovel itself, then all of a sudden that job went away. Now you would think that the survey department then would just kind of go away in a mine. But what actually ended up happening is those surveyors were able to work on higher value projects for the mining company and create additional value above and beyond what they were doing before. And it also required an upskilling on the mine side to understand that, hey, these new projects that we have for our surveyors require a little better quality of a surveyor than somebody that can go out and just bang a hammer on a stake and then run some flagging in between it. And so that's an example of changing the actual workflow, changes the jobs, and the mining companies have to be willing to adopt that, and the people have to be willing to do that. So it's competent people and agile people willing to make those changes in order to make the technology work.
That's great. Irena?
I had the same, I'm just reflecting on this. I think it's obviously people and education and the whole ecosystem. I'll give you actually an example. I made a presentation for schools to speak about metals and mining and steel. And I went to a school of my teenage son, and I put a slide asking children, what do they know about steel? So, you would get raise of hands, it's like polluting industry, you have all this stuff coming out of pipes, it's, quite ancient. And after that, I was presenting them with factual information around steel and how fundamental it is. So at the end of the presentation, you would see so much more interest from students and so much more, you could really engage them and entice them. So that goes back to the point, like it's never too early, right? We say people, but people comes from, that's your education, that's your mindset. So we need to start with the education. And of course, we also need to act now. And I think this is where the ecosystem and collaboration come and play, because none of us can do it alone. You see some of the most brilliant technologies, but you really need to have like heavy industry, key players to be able to adapt and adopt those technologies, right? To your point that, quite often you see the general tendency of being antagonistic to change. How do you change that, right? How do you ensure that some of the most interesting, initiatives, technologies actually being adopted and deployed? And this is where the collaboration, the partnership, the ecosystem build is really important. And the final point I would add, I'm a big fan of circularity. So I'm quite often focused on technologies of taken any sort of waste, and then now we're still making operations. We have all sorts of waste heat and waste gas and waste slag. So I'm quite pleased to see some of the most brilliant entrepreneurs to come up with the technologies to process, let's say, waste slag into alternative cementitious material, or waste heat into the stream of pure hydrogen that you can reinject back into the system to partially replace natural gas, or waste heat to energy storage. And I think, again, circularity is so important, and you can see it also, with the tailings from the mines. You can take them, it's not waste, it's actually a valuable source of, some of the minerals. How can we focus on some of those technologies to make sure that the industry is much more sustainable?
Great, thank you.
To me, the most important thing is how fast and how big to deploy any technologies to the market and transform the mining sector, for example. And I think the key is, at least for iPulse, trying to be as close to as possible to the end users. And the best way to be close to the end users is to becoming end user by yourself. For example, in this Typhoon system, this transmitter system, we established our own mining company. It's now called Ivanhoe Electric. It's traded in New York Stock Exchange now. But the purpose is that to believe that if our technology is the best in the world, we should use it by ourselves to maximize our value chain. Because it will take time to sell our technology to end users, explaining how best we are. But rather, it's best that we deploy ourselves as a mining company, and it was very successful. And of course, we cannot create an end user by ourselves in the old technology. So for example, in the rock crushing and the mine draining, we are teaming up with the major mining companies from the beginning, such as BHP, Rio Tinto, Newmont, Codelco, and Teck. They are all our major investors. And that we are learning a lot from them as to their actual constraint and as to how they operate on the field, try to optimize our technology and deploy it as fast as possible. And also, it will be very important to think about how to fully utilize existing infrastructure or the engineers to have a very quick deployment. For example, we are developing a drilling tool, but what we are taking in mind is to be able to use all the existing rigs and the drilling engineers on the ground. For example, we have like millions of petroleum engineers in the United States and 100,000 of rigs in the United States. So our tool is optimized to be used in the drilling, existing infrastructure and personnel. So these are what we think is most important.
Thank you. Flavia, in the 1 minute we have left, if you want to finish strong, in your mind, how do you wrap up the topic here and take us to the next level?
I think what we are all doing in technology, it's extraordinary in an industry that has got a lot of responsibility in the coming 20 years. This industry is the industry is going to get us to net zero, and we cannot do it with the status quo. We need to change. In 2 days, I'm going to be in Antarctica, and I am going to bring all our technology to test the subsurface of Antarctica as an analog of the moon. We have a beautiful planet, so we need to take care of it, and minerals will be the key, and steel will be the key. So technologies are the only way, not the only way, but one of the big ways to get there. So let's work together.
Collaboration, right? That's your point too. Will you please join me in thanking our amazing panelists for their insight?
Good afternoon, ladies and gentlemen. We're about to start our final session of the day, which is Mining 4.0, the new era of tech-driven mining. I'll hand over now to Leila Al-Habibsi from the Ministry of Industry and Mineral Resources, Saudi Arabia. Thank you.
Thank you. To move from ambition to reality. Before we begin, I'll allow our panelists to introduce themselves, not through biographies, but through the perspectives they bring to Mining 4.0. Amin.
Thank you very much, Leila. My name is Amin Al-Jaber. I'm the Chief Information Officer of Nesma and Partners. We are one of the largest construction companies in Saudi Arabia. We're involved in a lot of major and mega projects in Saudi, including the industrial projects that are happening here. We also recently acquired additional engineering capabilities and also data center design and implementation capabilities, which are very, very relevant to the story that we're trying to solve here in the mining industry and across all the industrial projects.
Thank you. We have Maria Huggeson from Sandvik Mining.
Hello, everyone. I'm Maria Hugosson, coming from Sandvik Mining. So Sandvik is world-leading technology and innovative and equipment supplier to the mining industry, working both in the surface and underground mining space and covering the full value chain from mine planning, optimizing how mining should be developed and done, and also all the way through the operations, the drill and blast process, and the extraction and crushing and screening. So an integrated player working with our customers globally. So I'm the division president of one of the divisions within the Sandvik Mining organization.
Thank you. We have Munif El-Munif from New Lab.
Good afternoon, everyone. Gun Mining provides a broad suite of technology solutions across the entire value chain to address productivity and safety and optimization for our mining customers.
Great. Thank you all. So, Dave, you've spent decades watching mining adopt and sometimes resist new technologies across jurisdictions, operators, and even business models. From your perspective, why does Mining 4.0 only succeed when it's treated as an adoption and enablement challenge instead of a technology rollout?
Yeah, technology is not the silver bullet. It's the organization's ability to adopt the technology and the agility of the people in the workforce and the competence of the workforce in order to adopt the technology in order to make meaningful change. And I think that's one of the things that we need to understand. I've been asked many times on panels similar to this is, Dave, what does the future of mining look like? And my answer is I don't know. But what I do know is that it's going to require people to invent it, and competent people, and that's really why we partner with our customers in order to provide a path forward for the technology and continuous development.
Thank you for that. Yeah. So if we accept that Mining 4.0 is fundamentally an adoption challenge, the next question becomes, what actually gets in the way? So Dave, you've written that automation itself doesn't create value. Operational discipline does. What mindset shift must mines make to move forward from successful pilots to scalable Mining 4.0 outcomes?
You know, it's interesting, when you look at automation, and I'm sure you've seen the same thing, the successful adoption of automation requires the leap of faith. Every single mining company on the planet has done a trial of automation using 1 or 2 or 5 different automated equipment. And they never actually get to the point where the automation forces them to change their work practices in order to optimize the automation. Because a human is much more flexible.
Yeah.
You get an amazing amount of compute power and sensory power in between the 2 ears, right? Which you don't necessarily have. And so because humans are more adaptable, then what you find is that you adapt your work processes around the limitations of the automation, rather than going the other way around and forcing the automation to cover all of the broad aspects and challenges that a human could just naturally just see, oh, there's a rock in the road, I'm gonna drive around it. And so it's that in order to make the automation work, it requires that leap of faith that we'll solve this problem with our workforce, not with the automation. Make that leap of faith and then start making those changes in your operational discipline in order to support the automation project.
Great. So if systems and discipline matter, culture becomes critical.
Exactly.
Munif, mining is often described as a legacy sector, guided by if it's not broken, don't fix it kind of mindset. How does this mindset limit technology adoption across the mining value chain?
Well, you've exactly said it. So it's mining is one of the oldest sectors and a legacy sector. At the same time, a lot of the mining companies have been operating in a certain way for the last few decades. And they've always operated under the assumption that this is working, this is great, let's continue following the same model. So you wouldn't see a lot of penetration and innovation, at least in the past. You wouldn't see it as much as we're actually seeing it much more today than the years before. So it's certainly a limitation, but then there's also a framing aspect. The moment you start saying, oh, we want to apply innovation, we want to apply this, people become slightly reluctant. Whereas if the framing becomes, I have this fundamental challenge within my operations, can a specific technology resolve it and solve it? Then you would see more willingness from the mining companies, at least that's what we've seen at New Lab, to actually go ahead and adopt. We're working with Ma'aden on solving specific challenges in terms of processing their mineral waste. And it was mainly about, I have this waste, I can't find a technology that can process it. Can you help me find the right technology to help process this mining waste? And from there, you would see more of a downstream effect to apply it across the entire mining value chain, from exploration to production and processing and so on, and then finally recycling. So yeah.
Interesting. So even when the mindset shifts, execution often breaks down around one reoccurring theme, which is data. So you've emphasized that technology adoption starts with proper data acquisition, data transparency, and you also mentioned accessibility.
Yeah.
Why is data the real bottleneck for mining innovation today?
It starts with data because at the end of the day, it was data that was guiding a lot of the companies to drill in a specific location depending on the ore deposits in that area. We've been collecting data for decades, but we haven't been able to actually identify the best location and resourcing to make use of that data. And I think now you're seeing a lot of startups, even like I can see some of them in this crowd, who actually are working and building algorithms where they can actually take the data that's been collected over the past few years and decades and actually make use of, in terms of, oh, there are potential deposits in that location, we should drill more in that location. And that's definitely, that level of accessibility of data has been a tremendous help to actually reduce the timeline of, or accelerate the timeline of exploration activity in the mining sector.
Definitely,
Yeah.
definitely. So let's translate the strategy into operational reality. Maria, from the perspective of a global mining technology and equipment provider, what are the most persistent operational challenges you hear from mining companies, especially when they're adopting new technologies?
No, but mining is a very complex workspace. Being a mine manager, and it's about, okay, what drilling space do we have? What equipment availability do we have? What are the maintenance programs? What are the supply chain constraints? What about the geology? What about the blasting programs?
Yeah.
And I think we have, at the mine sites, learn the way, how do we mitigate these challenges and what do we need to keep track of? And in a way you feel like I'm kind of in control based on the input that I have. So I feel to really change, it's so much about the change management. It's so much about the curious leaders, the curious people that really want to adopt the new technology, find the partners where they feel confident and be able to move ahead. Also, of course, upskill existing workforce, but also finding new people that really fit with the new technologies and what the requirement means. But I would say the main challenges is really about, change management and how can I be in control driving operation, because we know we need to keep process ore. That's how we make our income. And if I'm not in control with complex solutions, maybe I feel not confident. So it's a lot about the braveness, the partners, and kind of teaming up and partners that have skin in the game as well, not just giving promises.
It's a team effort, definitely. So we've discussed the barriers. Let's now focus on what actually enables adoption. Not in theory, but in practice. So I'll turn to you, Amin. Mining 4.0 assumes data-driven decisions, AI, and connected operations. So how critical is digital infrastructures like data platforms, data centers? How critical are they in making mining 4.0 deployable at scale?
That's a very important question, and I totally agree. I mean, if you want to make sure that you can optimize the operations, you need data. And even if we start talking about deploying AI solutions and what have you, again, the source of all of that intelligence has to be data. Yes. So what we do at Nesma and Partners, I mean, learning from the major projects that we've done, whether they are industrial or civil, for example, we've leveraged capabilities of the construction to make sure that we embed intelligence into the facilities as we build them. This is something that we've done in the oil industry, where we built a lot of intelligence through the existing technologies of IoT and collections of data available in some of the offshore fields, where a lot of the optimization can happen remotely to a level that you can actually operate the facility remotely through leveraging data, communication, and also the digital twin concepts. These are things that are proven. We have tried it. They work in the oil and gas industry, and I'm sure there are some applications that can be deployed in the mining industry. So this is something that we can bring to the table as far as the capability. Now, obviously, the location of mining it's a hard locations. Latency is definitely an issue. Communication always seems to be an issue. But there are new technologies available with low frequency and what have you that could enable some level of communication, collection of enough data to be able to make the decisions on site. So utilizing our company of Kent Data Centers, we've been able to design and deploy a high density but low frequency availability or potentially on site to make sure that we can collect data with less latency and to be able to make decisions on the spot. So that's an area that we're exploring as well.
It does. It shortens the decision-making time as well. There's usually pressure to jump straight into AI right now when people talk about this. So based on your experience across energy and capital-intensive sectors, what foundational digital elements must be in place for mining companies to properly adopt AI?
I mean, I did talk about them briefly in my previous answer, but effectively, if the facility or if the infrastructure is actually inbuilt with technology, with those sensors available as you deploy it, you automatically will be able to generate the data required. And obviously, then the challenge becomes how do you process that data, that massive amount of data, and if your data centers are way far from the facility, then it becomes a challenge. So if the facility is already built with that intelligence in place, what we call intelligent facilities, then already you'll be able to generate the data on the spot and be able to leverage that data as you collect them throughout the operations. And obviously, it doesn't only start, it doesn't finish at the exploration phase, but also follows you throughout the processing and the rest of the value chain throughout the organization.
Yes, definitely. So we've talked about infrastructure. We've talked about infrastructure and readiness. Let's connect this across the full value chain. So Dave, Mining 4.0 is often discussed in terms of machines and autonomy. From your experience across surface and underground operations, where do you see the greatest near-term value coming from?
That's interesting because the industry itself is being challenged in two ways. First of all, our commodities demands as a modern society and as we're growing in wealth across the entirety of the world is increasing. So we need to meet those commodity demands. At the same time, what we're seeing is a degradation of workforce in the mining industry. Yes. In North America, which is the one that I have an example for, there are 300 people more retiring that have gray hair like mine from the mining industry than there are new mining graduates going into the industry.
Yeah.
And so what we see is we see two different things that are happening. And well, let me back up. And then addition to the professionals and the degradation of the number of professionals that are entering into the mining industry, what we're also seeing is a lack of willingness of young people to go and drive a truck. Yes. or to do the physical labor in the mining environment. And so there's really two challenges in the mining industry right now. There is optimization needs in order to address the degrading levels of expertise within the mining industry. And there's also a business continuity issue around equipment operators where they're just not available. We've done a project in Western Australia for a mining company that basically the business plan for automation, for them to adopt the automation, was not that the automation was cheaper than having human drivers, but the fact that they just couldn't get human operators, so they couldn't actually access the ore body and extract the value from that ore body without having automation in place. And so I think it's very interesting the two different drivers that are driving both. If I think about what is creating the most value, I'm struggling because on the one hand you have to move the rock, and on the other hand you have to process the rock, and the processing has a lot of value, but if you don't have the rock in the first place, then you can't do anything. So I can't really answer the question other than to say yes, both.
It's more of a chicken and egg situation.
Yeah.
Yeah. Great. So before we look ahead, I want to make sure that this doesn't stay abstract. So Maria, when technology adoption works, what are the changes you actually see on the ground in terms of productivity, safety, and sustainability?
Yeah, and I think first of all I would like to productivity and sustainability goes hand in hand, and I think a lot about the efficiencies in mining is about productivity gains, and normally productivity really also feed the sustainability part of it. So I think it's about more efficient ore extraction. Secure that first of all we are drilling where we should. How do we have kind of the data and the knowledge about where should we drill so we don't drill in waste. Secondly, of course, how do we have the technology, the mechanical, the equipment and the optimum tooling that will enable us to make that happen. So of course when we drill in waste it leads to a lot. It leads to that, okay, we are moving rock, exposing carbon emissions to the surroundings, to the atmosphere. It also means that we need to load a lot of waste. We need to transport it from where we actually extract it, and then we have to take it to the crushers and the screeners and to the smelters, and that is absolutely complete waste. It means more consumption of water. Water, that is a scarce resource in most of the places where we actually do mining. It means we also consume more diesel, which is also exposing the environment with more carbon footprint. And of course, it's not good for the economy and not for the scale either. So I think it's really aligning technology, mechanical technology, what you get out of it, but also, of course, secure that we collect data, but also really draw conclusions and automate the equipment so we can have an efficient and world-class mining operation.
Thank you for that great addition. So we've talked about mindset, we've talked about data, we've talked about infrastructure, we've talked about integration and execution. So to close, I'd like to bring it all together. I pose this question to all the panelists. If mining gets only one thing right for the next 3 to 5 years, mindset, data, infrastructure, integration, or execution, which one matters most to unlock mining 4.0 and why? So we'll start with you, Dave.
Talent. It's not on the list, but it's talent.
Human capital.
Without people entering the industry and without the new ways of thinking that come with that talent and that fresh talent pool, the mining industry will collapse.
Right. Definitely. Maria?
No, but I fully agree with Dave. Without the talented people and attracting the best people in the world to contribute to the future, the mine of the future, it will be stalled. So, of course, also talent. But I also would like to highlight that we have a tendency to talk a lot about digitalization and data. I think sometimes we have too much data. What is important is that we analyze data, we draw conclusions, and we have talented people taking actions of the data, and that requires a lot of trust. It requires transparent dialogues in between kind of the end user, the mining companies, the contractors, and the delivery kind of companies like Sandvik, Hexagon, and us sitting here on the pool, that we really collaborate and put the operations in the center and draw and take actions.
Yeah, I would say, adding on to that, I think we need to differentiate between data and information.
Yeah.
And what the industry really needs is information, which is processed data. The data is only the input into that, because you need the information in order to make decisions.
Absolutely, couldn't agree more.
That's information versus data. Yes.
Yeah.
Maybe Munif?
Yeah, just echoing pretty much what David and Maria said. Workforce is an essential aspect in terms of making the mining sector continue to actually sustain or remain in the future. I would also add a technology aspect and a technology adoption.
Yeah.
But then also the technology cannot evolve without the right talent, without the right workforce to actually think about new innovative ideas. Unfortunately, the mining sector is such a complex sector. Like I heard in one of yesterday's panels, which is a funny analogy, might not be 100% applicable, but someone was saying, if it takes 200 degrees to cook a chicken at 2 hours, does this mean if you raise it to 400 degrees, it would take you 1 hour to cook it? And the reality is that it just takes time. And with mining, it takes time. So if we accept that, and if we have the right workforce to actually be patient enough to actually put in the time and effort to help continue unlock challenges in the mining sector through technology, I think that's going to help the sector evolve even more. Yeah.
I always like to tell people mining is a marathon, not a sprint. And finally, Amin.
Yeah, I mean, a lot of what David said resonates to the construction industry. I mean, not having enough talent or people who are interested to actually come and join the industry. So I definitely can relate to the lack of enough talent available or interest from talent to come to the industry. But I would say if there's one thing that we need to solve in the mining to really go to the next level of 4.0, I would say mindset, because technology is available and it's evolving rapidly. Data and ability to collect data is, I mean, we're getting new technologies by the day, enabling us to do that. And I think transforming that data to information, again, with the help of AI, that's also becoming something that can really leverage the availability of the existing technology. But really, mindset is what we need to focus on to make sure that we think about the possibilities and how can technology really help us move into the next level of mining, leveraging all the available technology. And obviously, talent would definitely be required as a second thing that we need to really work on from that perspective.
Definitely. Thank you all today for your time. It's very clear the Mining 4.0 is not just about technology. It's about the full ecosystem alignment. So thank you all.
Thank you.
Do we want a picture?